morning, guys. Happy birthday, Steve Diego. Hope it's a good one. Good morning, Ron. Mark, good to see you. Bob B. the man, nice to have you. Jeffrey Dean, one of my favorite headbangers. All right. Man, small group this morning. That's all right, though. We're going to do what we do, guys. We're going to talk about what we talk about. We're going to go screaming into the weekend, feeling good about the world. Today is Friday, February 14th. If you have a special somebody, you should think about reminding them that they're special. Otherwise, it's going to be a long, hard night for you. Every morning, coming in, checking news, seeing what's going on in the world, making sure there's nothing that's going to come out and make somebody with a whole bunch of money change the direction of the market. So at 8:30 a.m., there was some high-impact news. I wasn't even around to see what it did. But I do know that every time high or medium impact news prints and is released, the market has the potential to become too fast to trade, to change direction, to be erratic. And I simply make the choice. I choose not to trade during news. Most of the prop firms, you guys that are prop firm traders, they tell you that you're not allowed to trade during news. So being aware of it, I don't form opinions about what is being said or what they're talking about. I simply look for that red box and say, nope, not going to do it. Nexgen has a website. I'm sure you've seen it, nexgent3.com. It is a wealth of information, if you will. Education. There's a software guide. As you go into the weekend, I want you guys to know about this one. This is everything. This is NinjaTrader 8 best practices. If you have challenges with NinjaTrader shutting down, messing with you, go through the best practices. How to build new charts, screen capture programs. You should be able to take a picture and post it in the room because honestly, that's how you and I are going to have a conversation. Closing Ninja workspaces. Hey, good morning. Happy Valentine's Day, Miss Cindy. Hope your special someone treats you right. Guys, connecting accounts, moving, scaling charts, stops and targets. Everything you need to know about NinjaTrader is there in the software trading guide. And honestly, if you have a question during class, I want you to raise your hand and say, Mark, I'm trying to figure this darn thing out on Ninja. What do I do? I know most of the fixes. Miss Donna, type something. Every day I see you on your keyboard and you never say hello. I hope you're doing well. Like every time I see you typing in the chat box, I'm rooting for a message to come up from you. Putting you on the spot. The other tab that I want you guys to see is the trading guide. And this is where all the answers come from. The trading guide is where you're going to find the rules. The trading guide is where you're going to see the rules broken down. The trading guide is where you're going to see the rules for the next trades after you learn the basic trades. All of this stuff, swing trading, crypto, frequently asked questions and common definitions, things you're going to hear in the room. We really try to make sure that you don't miss out on anything, that you have everything that you need to be successful with the software. And that's what I'm going to give you this morning. As a brand new user, there is a path of least resistance. As a brand new user, there is a way for you to get proficient with this software, to understand what it's telling you, and to really have a very basic plan capable of winning more than it loses as you learn to get better with the software, as you grow with the software. Tell you right now, I haven't stopped learning. I've been looking at this stuff for 5.5 years now. And I learn something new every day. Put yourself in that mindset. You're going to learn something new every day. But if you create a great foundation, it doesn't mean that you can't profit while you continue to learn. So we're going to talk about a high probability trend trade. And the high probability trend trade is defined as when each indicator on every chart agrees for the rules for the trade. Triggers are their strongest. No termination conditions exist. There's nothing between you and your target, guys. This is the best of the best. And my first hour every day is focused on the best of the best, because when you look at this trade and you learn the simple rules for the trade, what happens is you become a chart reader. You can look at your screen, look at your workspace, and say out loud to yourself, I have these advantages, it's time to take a trade. Or, of course, the other side of the coin, I don't have the advantages that I need, I'm going to choose not to trade. And that's kind of what trading breaks down to. Are my rules met? My rules are patterns that have been proven to win more than they lose. They create an advantage. There is an edge. I'm obligated to take that trade if they're met. Or my rules aren't met. Why on earth am I risking my money without the advantages that I need to have an edge? I want you to develop that mindset from day one. So the high probability trend trade is going to teach you to recognize those advantages through chart reading. And chart reading is about 90% of your day each and every day. Chart reading is a lot. I typically have Scrabble or Blackjack up on another monitor. Sometimes I'll watch YouTube golf videos because I know that 90% of my day is going to be sitting on my hands. But 10% of my day will be actively trading because I have an advantage. I have an edge. I have a pattern that has been proven, validated, verified, studied, back-tested, and I know without question that this pattern has been proven to win more than it loses. So that's what I'm waiting for. That's my 90%, is waiting for those advantages. Once you get good at chart reading, once you understand some pretty basic concepts, you will understand where the market is likely to continue. This continuation point is your entry for the highest probability trend trade initially, and it will be your entry for other trades that you'll grow into. You're going to understand where the market is likely to go. One of the most outstanding things in this room is watching you guys take profits at these key Fibonacci areas and saying, man, that's exactly where my indicator said this market was likely to go, and that's exactly where it went. Good morning, Gary. And then finally, you'll understand where the market is likely to stop. And these likely to stop areas, these are what we call termination conditions. And this is a big red flag waving right in front of you saying, hey, don't take that next trade. Let's stay out of the market for a minute and see how the big crowds react. Gary, I saw that. So we're going to focus on chart reading, and we're going to do it with only 3 rules. Guys, simplicity is my favorite thing, and especially if you're brand new, and I know I've still got some new folks in here. Guys, we're going to take these 3 rules for the highest probability trend trade. We're going to break them down individually and learn how to study them. Each rule creates an advantage. So when rule number 1 is met, you have the advantage of momentum. Good morning, Dima. Rules in white, advantage in yellow. When rule number 2 is met, you'll have a clear path. When rule number 3 is met, you have defined your entry area. So as a brand new user, this is your core, this is your foundation. And I'm going to tell you that these first 2 rules, if you learn these 2, how to identify both, what happens is you end up with everything that you need to grow with this software. You end up with everything that you need to begin seeing the next trades. So when we break these down, understand that the first 2, these are your core, these are your foundation. If you have any questions, make sure that you're raising your hand. And we're going to find these 3 rules on only 2 charts. Again, simplicity. The fewer moving parts you have as a brand new user, the easier it is to get to where you want to be. Believe in your heart, there is more. This isn't one trade that you're shackled to for the rest of your life. This isn't your only trade. This is just your first trade. This is the best trade, the highest probability trade. And your large chart leads the way with this trade. The large chart will define the direction of the market and let you know which way, as a brand new user, you should be looking for opportunity. It will define the momentum in the market, letting you know whether or not you have that first advantage from rule number 1. And it will define the areas. You'll look to this large chart to find these Fibonacci areas, to understand where the market is likely to go, where the market is likely to stop. All of this amazing information, 66% of your advantages, come from the first bar on the large chart. Because the large chart is a very slow moving chart. The large chart is a broad stroke of a brush, if you will. And it really shows the overall opinion of the market. The precision of entry comes from a smaller, faster chart. The precision of entry comes from this fast-moving refinement chart that's going to define that point where the market is most likely to continue. And you're going to see 15 to 30 bars worth of movement on a small chart, while your large chart, single bar, doesn't blink, doesn't forfeit its advantages, doesn't show you any change. It's the refinement chart that's going to get you in and out. We had a great example of that yesterday. We took a live trade yesterday in the market, and our large chart never lost its advantage. Our small chart scared the heck out of everybody in this room because there were so many ups and downs. We're going to take advantage of those ups and downs, and we're going to create great entries. And we use these two charts because they are very much an example. I don't know what I'm looking. I lost my words for a second. They let you know who you're trading with or who you're trading against. Think of the large chart as a large crowd, and the large crowd has bottomless pockets. And the large crowd, Gary, don't even pay attention to yellow flag news. That's like telling me a chihuahua's walking towards me and it's mad. I don't care. Like those high and medium impact. Guys, the large crowd, the large chart, are the men and women with the money and the influence to create trends, to establish momentum. These are the men and women that react at those key areas defined by the large chart. Trading with them is typically the path of least resistance. Your small chart is the small crowd. Again, it's still a pretty good gathering. They've got money, they've got influence, but they don't have enough to beat the large crowd consistently. And your small crowd creates these fights. We call them retracements or pullbacks. And when everything says up from the big crowd, the small crowd says, hey, guess what? I found my uncle's wallet. We're going to make it go down 4 or 5 points. But these guys fail. 70 to 80% of the time, the small crowd fails. Rule number 3 on that refinement chart is designed to get you into the market, to give you a methodology to identify this pattern so that you can enter right where their failure is most imminent. This is the likely to continue with the trend area. And if they're losing 70 to 80% of the time, it gives you the opportunity and the potential to win up to 70 to 80% of the time. So I want you guys to keep it very, very basic. And we're going to learn the trigger line and the Fibonacci rules for when it's okay to trade. This is the first hour of every classroom that I teach. We break them down individually. We talk about what they mean to you as a trader in your trading business. We talk about how to identify them. And this is really what we're going to focus on. You guys have the ability to simulate. And I think the educational magic of this room isn't your ability to simulate, but rather it's the 15 hours live every week where you're going to get feedback on everything that you do. So I want you to practice. I want you to be willing to make mistakes. I want you to do it wrong so that you can learn how to do it right. But every time you take a trade, win, lose, or draw, I want you to take a picture. I want you to tell me why you did what you did, and I want you to drop it in the room. And it's a private session. I ignore everyone else in the room when I look at your picture, and I'm talking to you and I'm saying, hey, your chart read was amazing, or here's how you can fix it. Your entry was amazing, or here's how you can fix it. Your exit was incredible, or here's how you can fix it. So every time you post in my room, you get a one-on-one. Every time you post in my room, you're going to walk away from that conversation a little more confident and just a little bit better at your chart reads. So simulate and post in the room. And then we're going to simplify. There's that word again, simplify. I'm going to give you a plan today with 2 trades. It's going to be the highest probability trend trade that you could ever take, the one that typically wins 70 to 80% of the time. And it's also going to be what we call a medium probability trade. And a medium probability trade means that one of those 3 advantages have gone away. Specifically, clear path will have gone away in this second trade. So it's going to be a different set of rules that requires your understanding of the first trade so that you can manage it a bit more assertively, take quicker profits, protect yourself, because it's not the perfect trade. You've got to learn what looks to commit to. You've got to learn these looks so that they become easy. The more in tune you are with your rules, the better you are at knowing exactly what it is you're looking for to get into the market, the slower the market seems to move. And you can almost anticipate and get ahead of the market, waiting for your entries instead of watching them happen and then trying to jump in. So there's a path that's been going on for 20 years with Nexgen. In the 30 years we've been teaching, haven't had live chat rooms the whole time. And this is how you get to where you want to be the fastest. Post your trades in class. So everyone in this room, I'm inviting you right now, post your trades in this room. Tell me what you see. Tell me why you did what you did. If you are uncomfortable posting or you're not sure how to post, I want you to raise your hand. I want you to say, hey, let's do a little capture review. It's important to me that I get the most out of this software, that I get the most out of the feedback available. If you are absolutely terrified to post in front of a group of strangers, hold on. I want you to send me an email with a picture. One picture, one chart. I'm going to give you one freebie. And I want you to send it to me. And I want you to say, Mark, I didn't want to post this in the room because what if it's wrong? And guys, I will give you my feedback via email because it's important to me that you get that. And you'll find that it's so effective and it's so much easier to get to where you want to be if you make yourself just a little bit vulnerable. And Cindy's right. This is one of the most forgiving, friendly rooms ever. And it's a group effort almost. And it's very supportive. So post your trades in class. And then guys, use the spreadsheet. If you look in your Nexgen study picks folder, you're going to find the spreadsheet. I just dropped mine in the room because I update it all the time. And there's 4 tabs. Cindy, I still make mistakes. I made one this morning. Went long when I should have gone short. Oops. There's 4 tabs on this spreadsheet. There is the trade tracking. This is the first one. This is where you're going to take all the pictures that made it into the room and you're going to drop them into your spreadsheet. And here's how to annotate for the best feedback, how to post into the spreadsheet. Get that capture software if you can't find it. But you're going to talk about your advantages. You're going to start thinking about advantages every time you look for a trade. I want you to say them out loud. I want your pets to get excited when they hear strong triggers. And I want your cat to meow anytime you say out loud that you have a clear path. After you take the trade, you get the feedback. There's a section for feedback. So this is where you're going to put our discussion. Mark said I traded into a termination condition. Mark said this is perfect. This is your pattern. Don't ever miss this one. And what happens from about 4 or 5 pictures from you, I begin to recognize what your tendencies are. I begin to recognize if you're aggressive against the trend or if you're early on your entries or late on your entries or early on your exits. And what happens is you'll begin to see these things repeat themselves. And you're going to say to yourself, man, this is what I need to work on. Mark told me how to work on it. Let me eliminate the things that aren't serving me, the things that don't work, and let me focus on what is working every day. Bad at terms. You're great at terms, Cindy. You trade into everyone you see. You used to. But every morning, commit 2 or 3 minutes with your cup of coffee to looking at what you did yesterday, to looking at that spreadsheet, to reading that feedback, asking yourself what worked and what didn't work, focusing on the best of the best and eliminating the things that are robbing you of the success that you want. Guys, this will accelerate the learning, without a doubt. Your second tab is the basic rules. Strong triggers, clear path. These are your core. Know them. There are 54 pictures of strong triggers. Every picture is annotated, exactly why it's a strong trigger and what it means to you. The same with clear path. And then there's a section dedicated to what it looks like when your rules are not met, when you shouldn't be looking for that trade. Weak triggers. And then the Cindy section. This is actually the Mark section, Cindy. Termination conditions. And you'll see that I've given you an 80 picture head start on filling this out with your own stuff. But termination conditions are the most broken rule among new users because termination conditions keep you out of the market. Termination conditions force you to be patient. Termination conditions can stop the market instantly. And that's a big part of your 90%. So I'm going to give you the tool to go through and use this sheet and fill it out yourself as well. This is the trading client trade section. This is entries for long and short trades. This is a very basic management. And then even more ideas on management as you grow with the software. I've kind of given you a little head start there. There's almost 400 pictures of Nexgen users posting in this room, annotated charts, asking for feedback. And sometimes your posts are so amazing that I steal them and I drop them into this list. So this is a pretty awesome study guide for you to go back and start seeing these patterns, committing them to memory. And then there's patterns that repeat themselves, things that you're going to see every day. Once you don't have to think so hard about momentum and clear path, you're going to start to see other opportunities. You'll see a lot of that in the second hour when we start clicking on people's charts. You'll say to yourself, well, this isn't a high probability trend trade at all. And you're going to realize that it's a result of their ability to read charts, the pattern that they recognized from their study on the high probability trend trade. So know that this is coming. And also, here's a place to build your plan. Here's a place to put your pictures when it is your pattern. Here's a place to put your pictures when you learn how to manage better. Here's a place to put your pictures when you start to see those patterns. So I encourage everybody, you're not obligated. I can't make you get the work done. I encourage everybody, take at least 15 annotated pictures a day. If you can do that, and guys, I'm already over that for the morning. 15 annotated pictures a day is 300 pictures in your first 30 days, is 900 pictures in your first 90 days, guys. Almost 1,000 pictures in 90 days of study. And it's difficult to not be good at something if you put that level of work into it. And I always share this. I love to share it. And it's funny how much the number goes up each day. I'm at 1,055 pictures for 2025 so far. I teach the classroom. I still take pictures of everything that I do. I take pictures of my entries, my stop movements. I take pictures of my exit conditions to make sure that I'm following a plan. Guys, I take an awful lot of pictures because pictures are the path to getting to where you want to be. That recognition comes from the repetition. So we're going to learn it. You're going to practice it. I'm going to give you feedback on everything. I'm going to hand you a plan and everything that you need to be successful with the software when we're done with this first hour. Your job as a student in my classroom is to raise your hand if you have a question. Your job is to let me know if you don't understand a concept. And guys, what I really want to hear from you is if you need something to help you see the potential to make $400 or $500 a day with this software. If you're not seeing it, I want you to tell me what that challenge is, because usually I can address it. And I would say 99% of the people that sit in this classroom for more than a couple days know that it's possible to make money with this software, know that this pattern works, and know that it's doable. So if you're not at that level, I need you to raise your hand and let me help you. Let me see what you need and let me show you that potential. So let's get moving. What am I looking at when I open the software? You're going to see trigger lines. And this one's first because trigger lines are everywhere. They're on every chart. They're on big charts, little charts. If you build more charts, trigger lines are in every template. There are two trigger lines. There are small triggers. It takes two lines. They'll be solid. These are your small triggers. They are a fast-moving average. The large triggers are the dashed lines. They are a slow-moving average. That's about as deep into the tech as you need to get. Trigger lines are a part of everything that you do. First, they're going to define the momentum in the market. They are going to help you define termination conditions in the market, and they're going to help you define where you should be entering the market for this highest probability trend trade. So all I need you to do is know the difference between a small trigger and a large trigger. And if the market's going down, The small trigger is going to be red. The large trigger is going to be red. So the colors are a little hint on what you're doing as well, but know the difference between the two. Don't give them much mind beyond that. You're also going to have areas on every chart. In most cases, areas are just a horizontal line that prints on the chart. So we're going to name them. There's a divergence high line. It's this magenta line. It prints from a pivot if there's a loss of momentum. So divergence is synonymous with loss of momentum. It'll be cyan if it's from a low. You're going to see red Fibonacci resistance. So if the market is trending up, this is an area that could stop it, could create a bounce, could reverse the market completely. Fibonacci support does the same thing when the market is trending down. You're going to see yellow 1-to-1s. In an uptrend, it can behave as resistance. In a downtrend, it may behave as support. And then finally, you're going to see the midband. Midband runs right through the middle, and it changes colors throughout the day depending on where price is. If price is above, it's typically green. It may act as support. If price is below, it's magenta. It may act as resistance. So that's what you're looking at. Let's talk about how to use these triggers, how to use these areas to enter the highest probability trend trade. All we're going to talk about for the next 30 minutes or so is how to enter, taking these advantages and turning them into a trade. So everything starts on the large chart. Large chart leads the way. Big crowd, going with the flow, not fighting. Large crowd is going to define direction, and it's going to let you know whether or not you have strong triggers. Direction's the easiest lesson you'll ever get. If the background's green, market's going up. If the background's red, the market's going down. Remember, we're not fighting the large crowd. We're going with the flow. This is the world's greatest lazy river, and when you go with the flow, the pina coladas are free. So it lets you know which direction you're looking for rules to be met. In an uptrend, when the background is green, both the small triggers and the large triggers must be green as well. If the colors on your chart don't match, if the background doesn't match the trigger lines, if the trigger lines don't match each other, you do not have strong triggers, which means that you're in that waiting moment. You're in that 90% until the colors match, and then your smalls will break above the large, away from the large. The large triggers need to be wide, angled in the direction of the trend. The space created between the two, and I want you to picture scissors that have just opened. Those open scissors let me know that the odds are favorable for the market to continue up. In a downtrend, smalls are below the large, large are wide. My scissors are open. The space lets me know that the odds are favorable for the market to continue down. So strong triggers create odds favorable momentum. Strong triggers let me know that the market is more likely to push up or down. Strong triggers are what it takes to break those key Fibonacci areas typically. And strong triggers will even cover a lot of the mistakes that new users tend to make. But scissors close, strength goes away, strength turns into weakness, typically towards the end of a move. So when the small triggers work their way back inside of the large triggers, that weakening of the large triggers lets me know that anything can happen up or down, that there may be a bigger retracement, even from the middle of nowhere, that there could be an untradeable bounce. This is where areas, sorry, my NinjaTrader went to sleep on me. This is where areas tend to hold rather than break when there's weakness. So I want you to just from day one say to yourself, I'm going to insist on strength, odds favorable momentum. You'll see it on charts all day long, OFM. And I'm going to try to avoid weakness. I don't want to be in a market where anything could happen up or down because it really doesn't feel very advantageous. And let it be that simple. It either is or it is not. Is everybody good with that? This typically is one of the easiest lessons. Separation means strength. When they close, there's weakness. So on the large chart, when there is separation, we're going to look for opportunities. And the large chart's a slow moving chart. It's hard to see change on a large chart. But sometimes your large chart bars sprout these little tails, these little wicks, and that just happens when price moves below the midpoint. These tails and wicks are those fights from the small crowd. These are the pullbacks on that smaller, faster chart. you'll be able to pinpoint precisely where these tails are most likely to form using that smaller, faster chart. You'll be able to use these tails to go back and study this pattern. Even when the market isn't trading live, you can go back historically, understanding that each of these tails may have been a possible long trade. Each of these tails, with the separation with the strength, was a possible short trade. And these tails come into play when it's time to study. So rule number 1, momentum. I love it. Momentum is a fully loaded freight train going downhill with a tailwind. It's hard to stop. But we need to make sure there's not something on the tracks. We need to make sure that we're not trading into an area that may stop the market. That's a termination condition. Termination condition really is nothing more than a Fibonacci-based indicator that has the potential, that might reverse the market. And you're going to use a comparison of those trigger lines and the areas on the large chart, those horizontal lines on a large chart, to determine whether or not you have a clear path. Again, we're looking for divergence highs and lows. Yeah, we're still on the large chart, Mark. Haven't gotten off of it yet. We're going to look for divergence highs and divergence lows. We're going to look for resistance, support, yellow 1-to-1s. And what happens is these horizontal lines are where that large crowd is most likely to make decisions. So the large crowd buyers may buy and the sellers may sell. They may fight one another. These areas are where reversals potentially come in. So even if there's I love that you said that. Because one of the easiest ways to avoid problems is to understand where your rules are met. And the large chart leads the way. So Mark, we're going to use it to define the direction of the market with the background color. We've just defined momentum through the trigger lines. And rule number 2, making sure there's no termination conditions. That's a large chart endeavor as well. There's one termination on a small chart. When we get to entries, I'll show it to you. But everything is on the large chart. When these 2 rules are met, this chart is nothing more than an entry chart. It's just a refinement chart so that we can pinpoint where we're going to get into the market, because the large chart is chock full of advantages. Does that make sense? There's people in this room that'll tell you, just minimize your small chart. Don't even look at it until the first 2 rules are met. I think it's brilliant, but I don't tell people how to trade. So let's talk about the recipe for a termination condition. Since the large crowd, the people in charge, are likely to react at these areas, the first step in identifying an area that may stop the market is letting price get to that area, letting those dynamic price bars. In this case, trend up, everything's going up, the market's going up, and then it reaches Fibonacci resistance. When it reaches resistance, the only thing you have to do is ask yourself, where are my triggers? It almost seems too simple, right? Where are my triggers? Well, if my triggers remain below, it's a termination condition. It may reverse the market. It may create an untradeable bounce. There may be a fight right at that area for the next 3 minutes or 3 hours. But decisions are likely to be made at these areas. So rule number 2 is not met. You don't have a clear path, absolutely no trades into the area. And the same is true. If this area reverses the market and the market heads down, well, we're going to call that a strong top. Down it goes. That blue line in the distance, ladies and gentlemen, is a target. That's where the market's likely to go with all this momentum. It doesn't faze me. Don't even think about it until price reaches the area, until the large crowd on this large chart reaches that area. Then the decision-making process is set off. All I have to do is ask myself, where are my triggers? If they remain above that area of support, this area may stop the market, may create an untradeable bounce. It could reverse the market completely. We'll call it a strong bottom if it does. But the thing that I want you to get is that rule number 2 is not met. Absolutely no trades into that area. And guys, this is not only the most broken rule, but this is the rule that keeps you out of the most trouble as a brand new user. Once you commit to learning and believing in the idea that fibs can stop the market, that divergence highs can stop the market, that yellow 1-to-1s can stop the market, you'll realize that more often than not, any trade into that line results in a loser. More often than not, which means the advantage is gone. This was an 11-hour period. 36 times. 36 times rule number 2 kept you out of a loser. 6 times the area broke and offered you an opportunity to get paid. So areas break all the time. Let's look at it. When the market is trending up, the momentum is strong, life is good, and then price reaches Fibonacci resistance. And in that moment, the triggers are still below. This is a termination condition. All you have to do is wait and see what the reaction is. And you'll never know what it's going to be. All you have to do is wait. Is it going to bounce? Is it going to reverse? Are they going to fight? Is it going to break? If it breaks, this is what it looks like. Number 2 here is showing the potential to break, but it's not broken yet. So when my small triggers smash through the area, remember, price reaching the area sets off the decision-making process. Once price gets there, you're done with price. Price is done. The price bars could go away. It wouldn't matter. The trigger lines tell the story. Below, it's a termination. If 50% of your triggers, the small, the faster ones, get above the area, smash through that area, but the slower moving average, those large triggers are still below it, this look is what we call a 50-50 look. 50% of your triggers are through and 50% are not. This is not a clear path yet, but because of that momentum, this area has the potential to break. That's why there's the little pause button. You can capitalize on this look. You can take trades with this look, but because it's not a clear path yet, you will be managing much more assertively. But then finally, your small triggers and your large triggers, both lines of both, get above resistance. Resistance is broken. Resistance is no longer a concern. It actually behaves as support. And this path is going to remain clear until you reach the next area. So every time you hit a line, it's going to be a termination condition. And very often, this is where the market is likely to go. What a wonderful spot to take profits. Get paid. If it's going to break, it'll break. The first opportunity with the 50-50 look, and then it's trade away, look for an entry, guys. Same is true going down. Once you reach support, pump the brakes. Wait for the reaction. See what happens. It's going to show you the potential to break. It has to be managed assertively. But once it's broken, that path is clear all the way up until you reach the next area. So just for grins, let's open up a large chart and let's see if the market respects these lines. This is crude oil. Crude oil came from support way down at the bottom, bounced off of resistance, tried to break it, couldn't get both triggers above, retested support, straight to resistance, right back to support, straight to resistance, bounced off of support to test resistance, right off a divergence low, right to a divergence high, support again from the broken area, and then weak triggers, I'll be damned, that's where it started down. Guys, this is crude oil today. And rule number 2 is in full effect. Rule number 2 is keeping you out of trades into areas that could create big untradeable bounces. And that's pretty common. There will be times when your path isn't clear because the areas are stacked. Have you felt that frustration? I just can't get a clear path. I'm going to trade into it anyway. I can't seem to get these damn areas to break. I'm going to trade instead of being patient. I've done it. I was my nemesis for the longest time. Guys, this is 90% of your day. And I try to stress that a lot in the beginning, that 90% of your day is doing nothing. That if you spend 6 hours in front of your computer today, you're likely to be active for 36 minutes tops. The futures markets trade in the trillions. Trillions of dollars exchanged in the futures markets. Billions an hour. Every day. You don't have to be in every move. You don't have to be the first one in or the last one out. You don't have to fight. The easiest money you will ever make as a futures trader is trading away from areas two areas, finding your little bit in between, your base hits, guys. And it only takes $400 a day to be able to put yourself in six figures through your day trading business. So large chart leads the way. We're going to let the large chart do all the great things. 66% of our advantages are going to come from the large crowd. They're going to define the direction of the market. It's going up. It's going up with strength, and there's nothing in the way. I'm going to look for an entry. Only when my first two rules are met will I go to my smaller, faster chart to define my entry. It's just a refinement chart. We're going to take an x-ray of that one big bar giving us all this goodness. There is one time, Mark, you were saying, what if there's a termination condition on the small chart? There is only one time on the small chart where I'll let it behave as a termination condition and keep me out of a high probability trade. That's 3 divergences in the same price range. 3 times at a low or a high where that cyan or magenta line prints off the pivot. 3 losses of momentum in the same price range may terminate a trend. This is the only termination condition on a small chart. This fib is not a termination condition. Areas are defined on the large chart. The only time on a small chart I won't enter that short trade is if 3 divergences print. If 3 divergences print from a high. Becomes more powerful with weak triggers. That same lesson from rule number 1, that anything can happen look, coupled with 3 losses of momentum, is a little more powerful. If the third pivot is higher than the previous or lower than the previous from a high, more powerful still. So what are we looking at? We're looking at the small chart showing us change that we can't see on that big slow chart. This is the only time on a small chart I'll let it talk me out of the trade if I have momentum and a clear path on the large chart. Is that good, everybody? We're going to have one more picture. I'm going to show you some common examples of when the small chart talks new users out of trades. If there's not 3 divergences, rule number 3 is nothing more than defining the entry. Defining where the small crowd is most likely to fail. Defining where the market is most likely to bounce and continue with the trend. So rule number 3 says that I'm going to use a limit order to buy or sell a pullback at an area inside of triggers. And the language becomes very important for the precision. I'm going to use a limit order, which means I'm going to wait for the market to come to me. That's how precise we're going to be. I'm going to use a limit order at an area, at a fib, at a mid-band, at a yellow 1-to-1, because the same way they can create bounces on the large chart that hurt us, they can create bounces on the small chart that help us. But we want those areas to be inside of triggers, because triggers define where that retracement is most likely to occur, where that pushback, where that fight is most likely to go. So price may return to the large triggers, whether it is a small chart or a large chart. So in his infinite wisdom, John Novak took the large triggers from the large chart and placed them on your entry chart, the synthetics. They have little steps on them. And from the highest line of those large triggers to the lowest line of those large triggers, guys, this is where the retracement is most likely to occur, somewhere from the top to the bottom. This isn't your entry. This is just saying, hey, this is where the small crowd is most likely to push. And when they're spread, there is more room for that retracement, which means that the precision, the accuracy may go down a little bit. So for brand new users, again, I'm teaching the best of the best right now. I'm giving you the easiest of the easy. Favorable large triggers are the easiest way to get into the market. Favorable large triggers mean that your large and your synthetic triggers, they're overlapping, one on top of the other. 2 snakes riding piggyback. Because that gives you the smallest location for that retracement to return. It gives you the least amount of room to put areas inside to create a bounce. So I like to say it in one big breath. I'm going to use a limit order to buy or sell a pullback at an area inside of triggers. I'm going to use a limit order to buy or sell a pullback at an area inside of triggers. So let's define an entry real quick, guys. Let's go through, and this is the slowed down version. And you'll get to the point to where you begin to anticipate your shots because you understand the patterns. But once the rules are met on the large chart, I will turn my attention to the small chart to find my entry. It should say only when the rules are met on the large chart, brand new users, will I turn my attention to a small chart to define my entry. Everything on the large chart says up. It says up with strength. Everything on the large chart is telling me that I'm looking at a market that is likely to continue in the direction of the trend. So when I'm looking for this long trade, my large chart better look like this. Odds favorable. Hasn't reached the area. This is the absolute best of the best. So now I need the small crowd. I need the small crowd to fight. I need a retracement. And that begins with the reversal bar. So the reversal bar isn't your entry. The reversal bar is the signal that the fight is on. It's the beginning of the pullback, the beginning of the retracement. Isn't what a termination condition? Which one, Mark? This 1-to-1? The last screen I showed. This red line? Which one? We'll get there. We'll get the answer. The screen, okay. This one? It was on the left side. Okay, hold on. I know which one you're talking about. I got you. And guys, I love this. Always do this if you have a question. This one right here? Cool. Here's the top of the bar, 71.76. Did price reach resistance? So resistance isn't a termination condition. Are you worried about the mid-band in this case? Awesome. So let's do a quick lesson on when the mid-band is a termination condition. Thanks, Mark. I need to add this in, so I appreciate that you brought this up. You just made me a better teacher. I'm going to go to the termination conditions section. I'm going to go back and show this one slide. When we're defining termination conditions, and guys, this is on the PowerPoint, and I am going to give you my PowerPoint. The large chart mid-band mark is only a termination condition, if the large triggers on that chart are a full bar away. And that's something that we call the gap theory. So on your spreadsheet here, and all the pictures I took, let me find real quick. Crude oil mid-band is a termination condition. So let me show you exactly what it looks like. And I'm about to explain it. So the gap theory says that when price reaches the mid-band and the large triggers are more than a full bar away, well, how do I define that? Mark, are you familiar with the reversal bar marker? These are on both your large and your small charts. This gold bar is the exact price where this becomes a down bar. So let's go to the live market and look at it real quick. This gold bar right here is the exact price where this will turn into a down bar. That's what's called a reversal bar marker. And you have them on both the large charts and the small chart. This gold bar shows exactly where this bar will become an up bar. And there it was. When it hit it, we got the up bar. Does that make sense? And now the gold bar is below it, because since we have up bars, it shows me where this bar would have to go to become a down bar. It's a reversal bar marker. A reversal bar means that after down bars, they went up, or after up bars, they went down. You guys with me so far on this? Did that make sense, Mark? Sort of? So if price doesn't reach 71.48, 71.49, these bars are going to continue up. If from right here, this price bar goes down and reaches 71.49, I will have a red bar. I'll have a reversal bar. I had an up bar. I had an up bar. If this bar comes all the way down to 71.41, this will be a red down bar. So these gold bars define where the reversal bar will print. Does that make sense? How do we use it? First, we use it on the large chart. Let me find my picture here. But there's two parts to it. And the first thing, believe it or not, price reaches the area. Have you guys heard that before? Price reaches the area. Why? Because it sets off the decision-making process. So there's this idea called the gap theory. And if price pulls away from those large triggers, those synthetic triggers, super fast, and smacks into an area, in this case, the mid-band, if your large triggers are a full bar away, and you'll know that they are because, look, they are below the reversal bar marker, which means that I get a full bar right here, and it still won't hit the triggers. Does that make sense? From the mid-band all the way to the triggers, more than a full bar. This is the only time when that mid-band behaves as a termination condition. It's the only time when the mid-band says rule number 2 isn't met. And what it looks like in real life is very much like this. See how it pulls back? It sucks back to those large triggers. It hits the mid-band and it sucks back to those large triggers. Hits the mid-band, sucks back to those large triggers. That's when we're saying, man, no more shorts into that mid-band. Let's see if it closes the gap. It's pretty amazing how often it happens. There it is again. Right back to those large triggers. So on the picture that we had, those large triggers are super close. So the mid-band is a non-issue, Mark. Does that make sense? That was such a good question. Such a good question. This is how this classroom becomes a better classroom. When you guys type stuff like that in the room. Thank you. That's it. Only if it's more than a full bar away. So in this case, that's a non-issue for me. I'm not worried about it. In the live market, I hit the mid-band. Look at where my triggers are. They're on top of it. That mid-band is nothing more than a squiggly line. This support, however, is definitely a termination condition. Price reached it, even with odds favorable momentum. Price reached the area. Look at the bounce that happened. I mean, God bless rule number 2. Kept you out of that loser. Gary, that helped? Awesome. Awesome, awesome. For sure. Guys, I'm telling you, this is my favorite thing in the world to do. And when you ask questions, I promise you answers. So let's do it again. Let's start from the beginning because I am all about the digression. Large chart says odds favorable momentum separation between the small and large. Large chart has not reached resistance. And then our addendum, triggers are not a full bar away from the mid-band. Ladies and gentlemen, we have a clear path. Do you see how rules 1 and 2 are met on the large chart? This is your look. It's screaming north, guys. Even your small chart is screaming up. You probably have odds favorable momentum. I hope so. You have all of these up bars. Your triggers are up. They're kind of overlapping. You see areas. And now I need a reversal bar. I need the small crowd to fight. I need that pullback to begin. And there it is. And once I get that reversal bar, I'm going to define where the retracement is most likely to occur. That's where your trigger lines come in. So kind of a nice little segue there. On the large chart, remember when we just saw like 5 examples of price pulling back to triggers? Price pulling back to the large, pulling back to the large, pulling back to the large. It happens on the small chart too. So from the top of the triggers to the bottom of the triggers, this big white box, this is where the retracement is most likely to occur. Ladies and gentlemen, your trigger lines are not your entry. Triggers aren't bouncy. They're not solid. They're like clouds. High probability trend trades come from the areas inside of that retracement zone. Fibs, midbands, and yellow 1-to-1s. So this much smaller box shows where the small crowd is most likely to fail, where the market is most likely to bounce and continue with that trend that was established on the large chart. Everything says up, nothing to create a bounce. You're defining where that bounce is most likely to occur. Is everyone with me so far? Reversal bar starts the pullback. We're going to find our triggers. Triggers don't create bounces. We're going to make that box a lot smaller, areas inside of that retracement zone. Guys, here's where the trust comes in. And if you're still relatively new with me, it takes a little bit to develop this trust. I'm not going to lie. But if you put the study in, a little bit of participation, getting some feedback, you're going to have the courage to activate a limit order 2 ticks above that highest point of support. And you're going to say to yourself, okay, I had strong triggers on the large chart. There was nothing in the way to create a bounce on the large chart. I have defined exactly where the market is most likely to continue. I'm going to buy that sucker on the way down. I'm going to make sure I don't trip over a couple pennies to try to save a few dollars. And guys, at this point, you've done everything that you can do. You have controlled everything that you're in control of, and that's making sure that the rules are met. If the small crowd has it in them to push back, to get to your limit order, you are in a long position. You have just bought the market, but you didn't just buy the market hoping it goes up. You bought the market because you have the advantage of a market that is likely to continue in that uptrend due to strong triggers. And you have the advantage of a market that hasn't reached an area likely to create a bounce on your large chart because there's no termination conditions. And you have entered a long position right from the area where it's most likely to continue with that trend. And guys, this is the entry for the high probability trend trade. A trade is not your desire to win. It's not your hope that it goes up. A trade is nothing more than momentum plus a clear path plus an entry area. So let's go through it again, both directions. Large chart rules are met. And you're going to wait for reversal bar on the small chart. This is not your entry. This is the beginning of the fight. Where's that fight most likely to go? From the bottom of the triggers to the top of the triggers. Somewhere in here is where that retracement is most likely to happen. But where's it most likely to bounce? Guys, when you type this on your charts, area inside of those triggers, inside of that retracement zone, the tighter they are, the smaller this box will be. From the highest point of support to the lowest point of support, this is your window of opportunity. I love that phrase. The window of opportunity is where the market is most likely to continue. But because of the large chart advantages, your job is to activate a limit order 2 ticks above the top of that window. That's where the market is most likely to continue. Anything below the triggers, below the retracement zone, below the areas likely to create a bounce, anything on the wrong side of these triggers in a long trade, guys, this is out of the equation. This is where your advantage is gone. This is where your edge is no longer present. You don't want to be in the market. You don't want to take an entry down here because once you get past everything most likely to create a bounce, there's no telling if or where that market is going to continue up. In a downtrend, when the rules are met, the momentum is strong, the path is clear, we're going to wait for a reversal bar. The reversal bar signals the beginning of the pullback and it is not your entry. Very often new users jump in on the reversal bar. I know I'm supposed to wait for the reversal bar. Well, the reversal bar sets you up to define where the retracement is most likely to occur using those triggers. And then you define where it's most likely to bounce and continue with the trend from the areas within. And guys, this is one of those magical moments where there is one line inside the triggers. And that line is the point where the market is most likely to continue. And your job is to activate a limit order 2 ticks below it and taunt the small crowd. Come get me, small crowd. I want to be in this trade. Anything on the wrong side of the triggers, your advantage is gone. Your edge is no longer there. You don't want to take an entry up here because once you get above these trigger lines, once you get past the areas most likely to create a bounce, you don't know if or where that market is going to bounce and continue with the trend. So, by defining your entries, by creating that window of opportunity, you have just defined where the market should not go. And this is a great lesson in the beginning of your management because your initial stop will be placed where the market should not go. 4 to 5 ticks above those trigger lines for a short, 4 to 5 ticks below those trigger lines for a long. And guys, if the market pushes through everything and your advantage is gone, you're going to realize that it's better to take a loser than it is to hope, than to just watch it continue to rail against you from the wrong side of everything. And anything that wins 70 to 80% of the time. Do I have any math majors in here? How often is that trade required to lose for the math to add up? Anything that wins 7 or 8 out of 10, how many are you going to lose? 2 to 3, right? You don't get to pick the 2 to 3. It's a cost of doing business, guys. It's like paying rent on your storefront. So the idea is that you learn the pattern. You learn the pattern. You commit to the looks. You prove that it wins more than it loses, so you don't hesitate when the market pulls back to an area inside of favorable large triggers. This is the picture on how to study. So this is all historical. You'll find that learning the software as a brand new user in your first week or two, you'll get more out of taking pictures than you will out of taking trades. There's no doubt in my mind about this. So large triggers are up, small triggers are up, there's space between the two. Guys, I have strong trigger lines. Rule number 1 is met. Smalls are well above resistance. Large are right on there. They're breaking through. I don't have termination conditions because not only did I clear the previous, price hasn't reached the next area. This pink line is going to become a target if I get an entry. Is everybody with me? And guys, here's the deal. That's where the market's trading, 97.05. And in crude oil, that's 8 ticks. That is $80 worth of profit to get to trouble. That seems like grade A baloney, doesn't it? Who wants to take a trade with only $80 profit? Not me. But here's the deal. We're not trading from the top of that bar. We're waiting for the reversal bar. We're defining the retracement zone. We're entering at the areas inside of triggers, which means that from my grade entry, down here somewhere, I don't know, around 83, now that $80 potential turns into $300 potential because I waited for the pullback. Does that make sense, everybody? This is how rule number 3 is going to help you reduce risk, because if you're getting in at the bottom of the move, at the best spot, your risk is minimal. The distance to your target grows exponentially. So if I circle this tail on the large chart, and this is historically, and it lines up with an area inside of triggers on my small chart, the rules are met, this is my pattern. This is the one that I'm committing to memory. Can you guys give me a why if you're with me? This is my first hour every day. We didn't even talk about management. All we talked about was how to get in at the best spot. That's it. Let's go see, just for poops and giggles. Man, having trouble finding momentum here. There's a little tail right there. Let's see what it looked like. I'm going to circle that tail before we got to support. Didn't quite make my area inside of triggers. Maybe not a trade. Maybe not an entry. But what happens, guys, is this high probability trend trade. You can go through the spreadsheet. Here, let me push the spreadsheet over. I stole all of these from you guys. Momentum, potential to break, pull back to resistance inside of triggers, didn't go beyond the retracement zone, market continued down. So this is your pattern directly from the spreadsheet. Let's compare it with a different user. And I think that is a dead link. There's a few of those. Momentum, nothing in the way, pull back to resistance inside of triggers. The circle here at the top of the tail lines up with the entry here on the other chart. Let's see. Odds favorable, clear path, pull back to resistance inside of triggers. I'll be darned, the market went down. Oh, that's the one we teach with. That's not, but it looks just like it, doesn't it? Odds favorable, potential to break, right to the area inside of triggers. Notice that it's annotated, showing me exactly why. And off it goes. So you guys that are just learning this, Gary, who else is in here? Organic, you're a couple weeks in. How are we doing? Mark, does it make sense a little more when we go through it, when we talk about it, when we kind of break it down individually? My small triggers are green and my large triggers are red. Do I have odds favorable momentum? Guys, do I have that advantage of a strong trigger? What do you think? The colors don't match. The answer is no. That's okay. Price reach support. My triggers are above it. Guys, 7138 is a termination condition. Even with the bounce, 7138 is still a termination condition. You need to let your triggers get to the other side to have the highest chance of success. And they may. But there was a big ugly bounce that would have taken you out of that market. So that's my first hour. The one thing I say, and it probably sounds egotistical, and I'm okay with that, is that I'm going to give you everything that you need to be successful with the software, guys. You now know the rules. We broke them down individually. You have the ability to simulate. I'm about to give you a plan, so I got ahead of myself there. Here's how to study your rules. I'll give them to you. These are the rules. These are what they look like. This is what they mean to you. But you've got to learn to believe it. You've got to learn to see them in the moment. So the goal is that you first look at your large chart. You identify momentum and path. This is the core of your education, guys. And once you understand these two concepts, it opens the door for all the opportunities. So take 25 pictures each. Remember, taking pictures, not trades, for the first week is going to get you there quicker. I want you to take trades, but I want you to supplement those trades with a lot of pictures. Take pictures of strong triggers, weak triggers, clear path, and termination. The core concepts, having your rules met, having your rules not met. Explain why the rules are met or why they're not met, and then put them in your spreadsheet and go back and study them every day. Here's one from the spreadsheet. Smalls above the large, all green and wide. This is strong triggers. Momentum, rule number 1 met. Do you guys see it? That's your look. That's always strength. There it is again. This is always weakness. And if you go through and take these pictures, you'll never confuse the two. New users, you're saying, yeah, it's momentum, Mark, but isn't that a termination condition? Guys, I want you to get to the point where you break them down and look at them on their own. Give them their own merit before you turn them into a trade. When you look for momentum, all you're looking for is trigger lines. When you're looking for termination conditions, you're only deciding if price reached the area and where your trigger lines are. And when you're looking for the entry, you're looking for the areas inside. Learn those 3 very basic concepts, and what happens is you'll piece them together to create a trade. So as you go take these pictures, I'm going to give you the high probability trend trade checklist, and that's all it is. It's a checklist to enter the market from the high probability trend trade. And the first picture is the market coming from a strong top or bottom. It's not mandatory, it's not necessary, it's not one of the 3 rules. But a strong top or bottom means that the decision made at a high or a low was so impactful by the opposing force that it reversed the market completely and is giving you your rules met. So a strong top. First, it has to be a termination condition. It has to be a no triggers through, price reaches the area, triggers remain below, termination condition. If that termination condition reverses the market, makes the large triggers go from green to red, from resistance Now it's a strong top. And a strong top is the precursor to the highest probability trend trade you can take short. First, it's a termination condition. Price reaches the area, triggers remain above. Guys, this is mandatory. And it's not a strong bottom until the market reverses. So learn the language for a strong top or bottom, because a strong top or bottom is rule number one for almost every trade you take beyond this high probability trend trade. Do you have momentum, or is it weakness? How easy is that? Is it strong or is it weak? Are the odds favorable, or could anything happen? The language should pretty much make you commit to that look. Is it a termination? Pretty much every line will be, even if it's for a second. Does it only have the potential to break? And the only thing I want you to do when you say, wow, it's not a clear path, it's just the potential, I may have to manage assertively. I might have to be on guard, making sure nothing changes, guys. So when you talk about these advantages, you know how you have to manage a trade. But once that path is clear, let's look for entries until the next area is reached. And then defining your entry. And you guys are going to get all of these sheets. The second page is the exact same checklist where you can print it out, put it on your desktop, laminate it, grab a dry erase marker. But this is how you're going to police yourself. I'm looking for a trade. Do I have a strong top or bottom? Not mandatory, but I sure do like it. Do I have odds favorable momentum? Are there no termination conditions? And then guys, area inside of those trigger lines. These are also the words I want you to write on every chart that you present in this room. I want you to talk about these three concepts every time you post in the room, because you'll quickly get to where you ask, was this the right trade? To you're telling me, Mark, I can defend this in a court of law. This is a pattern that wins more than it loses. Never had anybody in the history of this checklist be able to mark yes to all four and do worse than 70%. I've had engineers put it through the ringer and come up with about, I think it's 83.2 or 82.3. I may transpose the numbers, so I don't want to lie to you. Guys, learn how to follow a checklist. A checklist is just a way to help keep you out of trouble and help you embrace advantages. And then you need a plan. I'm going to give you a plan. Everything you need. This is the KISS plan. How appropriate, right? Valentine's Day. This plan is a stepping stone in your learning journey. It's designed to optimize your chances of success with the high probability trend trade as a new user. When I tell you guys about the high probability trend trade, I promise you, I'm giving you the best of the best. And that's why I use that phrase, optimize your chances of success. But through simulation, study, class feedback, continuous practice, you'll be empowered to craft a plan tailored to your personal goals based on your experience reading the indicators. Once you can read your indicators, once you can recognize momentum and path, guys, you're going to start to see patterns and see opportunities. And as we get into the second hour, you're going to see some people doing some crazy shit based on their ability to read the indicators. And they've proven that it wins more than it loses. And it's not nearly as crazy as it seems to them because they're at a different spot. Before you enter the market, not on simulator, whether you're going to a prop firm, whether you're using your own money, it doesn't matter. You need to know why you will enter a trade, guys. These are rules. Rules are nothing more than a description of a pattern that has been proven to win more than it loses. And if you verify and trust this pattern through your study, through your class feedback, through your continuous practice, there's no reason to not consistently enter when your rules are true, because you know it's going to win more than it loses. That's what we've been talking about for an hour. Your rules will help remove the emotions. You'll start getting bold with your stop placement and say, these guys are going to have to come get me. I'm not giving it up with this pattern. And then you have to know why you will exit. Why on earth am I going to exit this trade? Well, exit's either taken at a profit target or because my advantages are gone. That's it. So maybe I'm in a long trade and I hit a mid band on the large chart, and the large chart, large triggers are a full bar away. Well, that's trading directly into a termination condition. What an amazing place to take profits. Maybe I get 3 divergences on the small chart. That could terminate the trend. What an amazing time to exit a trade before my profit targets are reached. So, Define your entry, ladies and gentlemen. Focus on entries. Learn how to get into the market where the market is most likely to continue, because great entries create very manageable trades. I'm going to share my favorite book. This is my brother's bestseller, How to Commit Financial Suicide in One Easy Step by John Novak. Chapter 1, Warning Signs Your Friends Are in Trouble. They're trading against strong triggers. They're fighting the direction and the momentum of the large chart. Chapter 2, Warning Signs Your Friends Are Not Paying Attention. They trade in determination conditions. Guys, this is a tongue-in-cheek, joke kind of way of saying these are the two most common problems with brand new users. Trying to be first or trying to be last. And if you can weed these out of your day, you're better than like 70% of the day traders I've worked with over the years. But once you enter at an area inside of favorable triggers on the 5-1, you got to manage. You got to do something with that great entry. You got to get it to profits. You got to protect yourself. And the KISS management plan is designed to help you understand and trust the stop placement, as well as being focused on getting profits captured quickly. The goal of day trading, I'm going to type this in the room. I don't know if you guys realize this. The goal is to get paid, right? If you put $1,000 into your account, does your account get pissed off if it was 10 deposits of $100? Does it require you to put in $1,000 all at once? Guys, getting paid. Things add up. So your management plan is based on 2 contracts. You will create a plan based on your ability reading the indicators as you learn to read your indicators. But in the beginning, we're going to focus on getting in at the right spot because it defines where the market shouldn't go and gives us the least amount of risk. So if my entry is 2 ticks below resistance, inside of triggers, that's a triple G trigger. You know that's good. I just realized the typo. Then my initial stop is 4 to 5 ticks beyond the triggers. If then, and this is where the market should not go. My entry is at 71.34. My stop is at 71.49. This is $150 risk per contract getting into this trade. You'll know where your risk is before you ever enter the trade. You can decide whether or not you're comfortable with that. If you're not, this isn't your trade. If you are, guess what? There's nothing else to do. You're either going to get stopped out or it's going to go to one of your profit targets. And your profit targets are predefined in the KISS plan. $100 and $200. Arbitrary numbers that have nothing to do with triggers or areas. These are learning how to get paid. So if it doesn't hit my stop, that means it probably gave me a reversal bar in the direction of my trade, confirming that it's going down with the momentum, with the path from the area. My new stop will be 2 ticks above that reversal bar. So my entry is 71.34. My new stop is 71.37. Now I have $30 risk per contract. I went from $150 to $30 risk per contract. It doesn't guarantee a winner. But what I've done is I've redefined where the market should not go. And I've reduced my risk. And even if this becomes a loser, who cares? It's $30, right? So it's either going to hit my first target or I'm going to take a tiny little loser. With all of the advantages, with my great entry, it's more likely to hit my first target than it is my stop. More likely. And I just made $100. And if price reaches that first target, one contract is automatically removed. Those funds go into my account. Guys, that's success. Confidence comes from the memory of success. And then with one contract remaining, I'm going to move my stop to break even. I'm going to take 100% of the risk off of this trade. And is this your best stop placement? The answer is no. I'm going to tell you right now. The answer is no. But you will craft a plan tailored to your personal goals based on your experience reading the indicators. This break-even stop is reminding you, and you're developing trust in the idea that your large chart is screaming down with nothing in the way, and it's more likely to make it to this fib than it is to reverse because it's hard to stop a freight train. So if they don't hit my break-even stop, they're going to my second target. And my second target is only $200 away from that great entry, which means 2 contracts, 1 trade, 4 minutes of my life. I'm out of the market with $300 profit. And anything that happens after this doesn't affect me because I'm not in the market. I'm done. That's $300. And this is where all my naysayers, all my big truck driving guys say, dude, $300 is crap. I don't want $300. Guys, $300, if that's the best you do every day, that's a $75,000 year. There's not one person in this room that would be pissed off about 75 grand a year for 4 minutes of their life a day. There's no doubt in my mind about that. Take another trade. Get out for 100 and break even. You're in 6 figures. This daily goal sheet is to remind you that you don't have to make all the money at once. Guys, learn how to take the best money, the easiest money. Reach your goals consistently. Long term, that comes from taking the best trades, not all the trades. So you're going to get that as well. And I'm going to give you everything, right? Everything. You've got the rules. You've got how to study the rules. You've got how to annotate your charts. You know exactly what areas are. You know where to find your rules. Everything. Not yet, Wayne. We're on a roll. You've got a spreadsheet where you can track your trades, where you can put your study materials, where you can study other people's stuff, where you can build your plan. I'm putting a zip file in the room right now, and it's called All You Need. And guys, it literally is. All you need to be successful with the software. I'm putting my spreadsheet right below it, just in case you didn't grab it the first time. Inside of this All You Need zip file is the Chart Reading 101 so that you can identify advantages quickly. It is the PowerPoint that I use to teach this classroom every day. It's the High Probability Trend Trade Checklist so that you can police yourself every time you take a trade and know what to write on your charts. It is the KISS plan. And the KISS plan has not only the highest probability trend trade that we teach, but it gives you the plan for that second trade, the 50-50 trade as well. I have taken and put on this, in that zip file, what's called the Trend Trade Simple document. And it is everything that we've just talked about for an hour, consolidated into 2 pages. And then there's one more. It's the pictures you can take, guys. And I can't stress the importance of pictures enough. And more importantly, putting those pictures in the room. Take pictures pre-trade so you can go back and study and make sure you followed your rules. Take pictures during the trade. Did anything change? Stop movements are recorded. There's no reason to annotate either of these in the moment, guys. You're trading, you're busy, but it takes a half a second to snap that picture. You'll use this one to come back and work on your management. After the trade, from entry to exit, annotated with rules and reasons, and then finally no trade. Hey, my rules weren't met. It's not perfect. This isn't for me. Here's why. Sticking to your rules. Guys, pictures 3 and 4 are the ones to put in the room. These are the ones. Trades from completion. I love it when you guys show me an entry. Show me an entry and the exit in the same trade. Let's see if there were opportunities for management. You'll get feedback on everything. Everything. All 3 advantages, and then anything else I've got in my brain to help out. And it's a great lesson for everybody when you put the no trade pictures in there. And let me show you why. I'm going to go back to that one picture that we had. Because let's use this as a no trade example. And you drop this in the room and you say, hold on. Didn't take trade because of small chart termination condition. How many people other than me have let 1-to-1s or a fib on a small chart talk you out of the perfect long, out of the perfect short? Guys, I was notorious for this as a brand new user because I forgot that terminations are defined on the large chart, that only 3 divergences on the small chart should keep me out. I've done it. If you haven't done it, or no, don't admit to it, and you don't have to admit in the room, you're probably kidding yourself. Other things. Well, Mark, the small triggers turned against me. This wasn't my long trade. The momentum sucked at this point. Anyone done that one? Can I put my hand up again? I don't want to fight those triggers. The colors don't match. Guys, look at the momentum on this chart. That one bar. Momentum is defined on the large chart. So you've got to learn these lessons, that repetition. And if you give me it's not my trade, and it looks like this, we'll talk about why it's your trade. And you just added an arrow to the quiver, you've got more reasons to enter the trade. So that's my first hour. It's the same hour every day. Everything you need to be successful with the software from entry to management. The only thing that Nexgen can't provide is experience. The only thing that I can't give you is the drive to do the work, the drive to take the pictures, the courage to post in the room and ask for help if you need it. I'm going to remind you that every successful sports player that you idolized as a kid had a coach. Every person you worked with as a mentor that brought you up in your chosen career had a mentor themselves. Take advantage of the coaching in the room. Take advantage of the idea that I've been there, that I've done that I've made those mistakes, and I've learned how to fix them. I'm going to open up the S&P while I go on break. So when we get into the second hour, this is what we're going to do. And I give this every day before I do the second hour. The key to everything is a foundation. I can't stress that enough. Gary, I know you're about a week in with me. We're building that foundation, right? Hopefully you see the potential, what the software is capable of and what you'll be capable of with it. So we build that foundation, and I blanket you guys with very conservative rules, that recognition of advantages. I hand you that plan designed to optimize your chances of success. And Chef just posted in the room, and I've got to say it because I think it's important. People can get qualified in these funding accounts in their first 30 days with Nexgen by following the KISS plan. It's happened multiple times. So let the bad stuff be bad in the beginning. You'll learn how to work around it in the beginning. It's me, I'm people. Yeah, you are. And just like anything, the more time you spend with the software, the more you're going to see. So learn the process that yields the results, and the results seem to follow. Guys, that's where the KISS plan comes in. If you keep it that basic, if you follow simple rules, if you're okay not looking for all the trades, and I always say this going into the second hour, because you're going to see trades that aren't even close to high probability trend trades. Don't take them as a rules violation. Understand this is where you're headed when you learn how to read your charts. You're going to find these opportunities that other people seem to be getting without you because they're just further along in the study. Keep it simple. You'll be where you want to be faster, and question everything. And Mark, again, thank you. Mark said, but Mark, that's a termination condition. And we just clarified mid-band termination conditions because he asked me a question in the room. So as we get into the second half of the room, guys, if it crosses your mind, type it in that chat box. Let's cover it. Let's talk about it. Hell, I don't care if we run over today. I'd rather run over because of so many questions than feel like I have to do it short because nobody's asking. So when we come back, we're going to talk about every chart that's been posted. I'm going to go stretch my legs, and I'll see you guys in about 5 minutes. Unmute everything, get it going. Hey Mark, check it out. Price reached the mid-band. Look at where those triggers are. I wonder if it's going to close the gap. We'll have to find out. All right, so I'm going to scroll up to the very top of the room. We're going to start clicking on pictures. We're going to talk about momentum, path, and entry on every one of them. Joel got us going today, and Joel said, check it out, Mark. I've got odds favorable momentum. Those small triggers started to break. It was close. There's the potential for this one to break. Let me take an entry right in an area inside of triggers, and down it goes. And Joel, that's an absolutely beautiful trade. And then Miss Jen, I like this. We're going to see what Miss Jen did. I did unmute YouTube, Wayne. I did. Thank you. Man, I appreciate that you said that. But I've got a huge note on a notepad in front of me. All caps. Unmute. Unmute. So it's kind of funny. I'm trying to not make that mistake, but I do every now and then. Good afternoon, Miss Jen. No, always double check me, Wayne. I'm human. Jen says, check it out, everybody. Strong bottom. No triggers through termination that reverse the market. This is a strong bottom. This is the precursor for the highest probability trend trade you can take. And it's also rule number one for that 50-50 trade, that odds favorable momentum with the potential to break. Jen's coming back. And Jen, I like this one. You said you had an order at the yellow one-to-ones in the mid-band. In hindsight with NASDAQ, you think it should have been on the other side, on the close on the other side. And I posted in the room, and I'll say it out loud. When you got to these areas right at the trigger, Jen, those small triggers were probably way more than a full bar away. I don't think there's anything wrong with that entry. I think your understanding of where the market shouldn't go kept you in the trade. And it's pretty much the exact same entry. And then your hold is beautiful. Out at the first, out at the second. And I don't know that you could do this 50-50 trade any better than you did it, Jen. It's absolutely beautiful. Great trade. Is it starting to slow down a little bit for you? Starting to feel like it's not moving quite as fast as you get a little more comfortable with what you're looking for, I hope? Much better? Good. It's just repetition. You're even starting to enjoy it. Uh-oh. It's just repetition, right? Guys, the more times you do anything, the easier it gets. It's Friday, so Friday I tell stories. When I was in my early 20s, I moved to Boulder, Colorado because I wanted to learn to snowboard. That's how my brain works. I want to learn to snowboard. Well, why take a ski trip when you can just move there? So I moved there. Bought a snowboard having never been on a mountain. The same way some of you buy software before you learn to use it. And that's okay because now you're committed to learning the process. And for those of you that know Colorado, there's Loveland, and it's a ski area right by Loveland Pass. And they have a ski lift that drops you off right at the top of a blue slope. And blue is not the easiest, but it's not the hardest. But if you're brand new, it's terrifying. And I used to sit at the top of that slope, and I would buckle my bindings, and I would look over what seemed like this crazy edge. And it would take me a second to get going. I had to think through everything. And by the end of that season, I would get off of the lift, and I'm already sliding down the hill, and my bindings aren't buckled, and I'm screaming down head first, and it felt effortless. And the repetition of learning the task made it simple as time went on. And Jen, that's exactly what you're doing. Is the more time you spend doing the same thing, the easier it becomes. So I'm glad to hear that it is getting easier, that it is much better, and that you are starting to enjoy it. The stress is out. All right. Steve Diego says, check it out, guys. Odds favorable momentum. He knows it's odds favorable momentum because there's separation between the small and the large. And he says, I'm going to let the back of the bar get away from the midband because the midband could be a decision-making point. In this case, it wasn't, Steve, because large triggers were so close. You could have been in sooner. And Steve says, check it out. I'm just going to try and capitalize on momentum. Because with this chart screaming and this chart screaming, there's an opportunity for me to make a couple $100 and get out before things change. And you did it beautifully. And then Steve, the only lesson I could give on this one, and I think it'll be helpful, is that because the large triggers aren't a full bar away, the mid band isn't necessarily your challenge area, which means you might have been able to get in just a little bit sooner, a little bit easier, especially when it's coming right from that perfect looking trend trade. So great trade, man. Nicely done. And then the next one, strong bottom, odds favorable, potential to break, not broken. Divergence prints, which is a little bit of a red flag, but you take the great entry, you know where your stop goes, and you just say with all this momentum, I'm going to keep my stop in place until I have a reason, and then eventually you get out right when everything starts to go great. So Steve, there's a look on your small chart. When everything rolls and starts going back in the direction, man, this is what we call a continuation style entry. So rather than an exit, it gives you an opportunity to kind of go with the flow. Let me find that picture for you. I've got pictures for everything, I think. And this is a good one for you guys that maybe a couple divergences takes you out of the trade or 3 divergences print. You're like, ah, but the large chart's still perfect. Bring that up. And it's this one right here, letting everything roll. And that looks exactly like the one that you posted, Steve. Guys, this is a good one for your spreadsheet. Getting in there and finding a way when the large chart is still great. A lot of times there's a way to get back in that trade. Great trading, Steve. All right, let's scroll up. Wayne, I believe you're next. So for you guys that I told you, you're going to see people fighting everything based on their ability to read indicators. Wayne is one of my fighters. Him and Ron are on this hell-bent mission to give me heartburn. So much so that he even puts it on his chart sometimes. So we're going to go a few things. The first trade, weak bottom, price coming up to multiple fibs, HVA lines, 1-to-1s on 3 charts. And then Wayne, the one thing that you didn't mention on this chart, and Mark will recognize it, Gary, we'll go through it 100%. Promise, we will go through it 100%. Hey Mark, do you recognize the gap theory there? Price hit the mid-band and Fibonacci and the large triggers didn't follow. Wayne recognized it. He didn't put it on there, but there's no doubt in my mind. He saw terminations everywhere and the large chart, large triggers more than a full bar away. And he said, you know what? I'm going to take a chance. He fought everything. He fought direction, momentum, everything. And he said, I'm going to take a chance on this one. And I'm going to enter at Fibonacci and hope that it works. And he said, but I know it's not high probability. I'm fighting everything. So I'm going to try and get paid quick. And man, it's aggressive as all get out. This is a low probability trade. It really is. But it's one that he's comfortable with because he's studied it. And then when the termination rolls the triggers, gets an HVA line, then he says, all right, I'll hold this one longer. The first one is the I hope this thing holds. The second one is my indicators are telling me that it is holding. And there's a big difference between the two. This one gets stopped out more than it doesn't. That's a more conservative approach. Doesn't mean this one's wrong. One fights everything, one lets it slow down and reverse. Don't worry, Wayne. I'll get to the next pick. Second trade, strong top with divergence on the small, and there he goes. Better entry, and I love that. 5 triggers rolled. Wayne knows that the large chart doesn't show change real quick, and his small charts will show him the change that he can't see as it happens, and that's what the trigger's rolling. Smalls get below the large, fast get below the large. terminations, divergences. And this is beautiful, Wayne. I love this trade. And this is nothing more than a momentum trade. This is taking that small chart momentum from a termination and finding a way to capitalize. And then, Mark, do you see where he got out? When the gap closed on the triggers, he traded the gap to the triggers. And he said, I'll get paid, and then I'll just wait for the next trade. Wayne, I love your chart reading. I really do. And it looks asinine if you're on day one. Why would he do that? But then you start putting chart reading into it, and you're like, oh, wait a minute. That makes sense. I kind of see why I did it. But I am going to show one thing. And I see this a lot, and this isn't for Wayne. This is for you people that want to be that bold. If you sold the fib, you got slaughtered. And then if you sold the mid-band, you got slaughtered. And then if you sold the one-to-ones, you got slaughtered. 3 losers in a row. Same look. Large triggers were a full bar away, everything. So I want to take that and I want to show how Wayne took the aggressive one, because when you trade as well as Wayne does, you got a little money to lose if it doesn't work. And then that was, instead of hoping it holds, allowing it to hold. And then it was really easy. Wayne, great trading. Great trading. It's been fun watching you get better. All right, Miss Jen. Not odds favorable momentum. I agree. There is a clear path, and you said I'm going to choose to wait. Without a momentum to push the market in the direction of the trend, I would rather do nothing than hope. That's hard to say. If you haven't been in a trade for a while, it's hard to say, man, I'd rather do nothing. I think it's going to go up. Everything's green. My path is clear. But my rules aren't met. And it looks like it saved your bacon a little bit. Nice job. Great patience. That's one of those. My rules aren't met. I choose not to trade. It did go down or it did go up? It did go down, didn't it? I think I posted a picture in the room of that trade. And that was it right there. Recognizing the change that hurts your trade. Exiting before targets are hit. I think that was it. And then I told you guys I take a lot of pictures. And then there it goes. I mean, way to avoid a loser. Guys, the difference between really strong, profitable traders and people that struggle is the ability to do nothing. And then here we have the 50-50. Close, questionable. But no divergence, super strong, super strong. Momentum covers mistakes, right? Trading into the termination, and that is a termination. But getting in on the right side of things and being willing to exit right at the problem area. And that's just a quick little hit. And Jen, I like this. If you're going to take a chance, and let's think about it. And I want you guys to see why we talk about advantages and why I harp on advantages so much. Because I know Jen did this. Jen said, all right, let me look at my charts. Do I have momentum? You're darn right I have momentum. It is screaming on both charts. Momentum is hard to stop. I've done the study. I've seen the pictures. I know momentum is hard to stop. Do I have a clear path? She's like, well, almost. And then she said, well, do I have an entry area? And she said, hell yeah, I have an entry area. And then Jen said, because I'm her lawyer, I'll speak for her. With 2.5 of the goodness, I'll take and manage at trouble. Does that sound about right? You talked through the advantages, you knew what you were up against, and it allowed you to feel comfortable and confident getting out at the trouble spot, but you believed in momentum to push you up there. And I love this. And guys, this is next step. This is amazing chart reading. and it's creating results. So great job, Miss Jen. I need you to do something wrong today. Just kidding. All right, Ron says odds favorable, clear path. It didn't make the mid-band inside of triggers, so he said, you know what? I'll catch it on the way down with all that momentum and just take a quick hit. Base hits pay for golf. Amen. How'd you shoot yesterday, Ron? 87? 89. I've already got your golf game figured out too. Took the same trade, Pete? I like it. You'll see a lot of that in this room where people are taking the exact same trades from different time zones. All right, Miss Cindy. Boom, boom, boom. Okay. Termination, strong triggers, potential to break but not broken. So far, I love the large chart. Read. It's letting you know what you're up against, letting your husband know what he's up against. No divergence, strong triggers, pulls back to the area inside of triggers, and it didn't work. So what's the lesson I can give him on this one? That's the same trade. Okay. So Miss Cindy, I need you to play messenger for me. Or if he's looking over your shoulder, on the NASDAQ, looking for trend trades. I don't care how high probability it is. Guys, this is a NASDAQ specific thing. When the rules are met on the large chart, 100%, and they were outstanding. When you reach your area inside of favorable large triggers, guys, when rule number 3 is true and you want to enter that market, the NASDAQ doesn't use a 13.2 and a 5.1. The NASDAQ uses a 34 and a 13. Your time frames are 3 times bigger because that market is 10 times faster. So the small triggers on the large chart carry a lot more weight than they do on a 5.1, which means fighting these small triggers rarely works out. It rarely works out. So if you get to your areas and those small triggers are less than a bar away, sit on your hands and wait for the close on the correct side. Get to the other side of that momentum indicator. Oh my gosh, 5.1 on the NASDAQ would be crazy. But if you reach the area inside of triggers and the small triggers are a full bar away, get in at the area. Be prepared to manage when they get there. So Cindy, if you want to share this picture with them, it's on the spreadsheet. It probably could have kept him out of that. Whoops, that wasn't a very good picture. It probably would have kept him out of that trade because it looks like the small triggers were screaming down and pretty close when he reached his area, and he never got the close on the correct side. And I'd love to see what the market did next. Did it bounce here, give a close on the right side, and head back up? That little patience piece on the NASDAQ, guys. I blew out a lot of accounts learning that lesson. So I hope that makes sense. And there's a good example of it. Just waiting for it to get to the other side. Typically pays dividends. Good stuff. All right, who's next? Line them up. Knock them down. Here we go. All right, Pete. Weak triggers at a fib, odds favorable momentum, nothing in the way. And Pete said, check it out. I'm going to try the long at the top because he had no momentum, but he did have path. He tried it from the wrong side, didn't work. So Pete, I have to point this out for the lesson in the room. Usually when my more experienced traders do this, this was a calculated choice. But for you new users, I want you to see a couple different things. This first trade didn't have momentum. Does that make sense, everybody? The small triggers were inside of the large triggers. There was no momentum. All the triggers were above the area, so the path was clear. Anything can happen, absolutely, Joel. And then when we go to rule number 3, and this is why I want you guys annotating your charts. Entered on wrong side of the triggers. And you're like, okay, well, how does that help me, Mark? Let me show you. If I go back to the very basics, if I talk to myself in terms of advantages, I didn't have momentum. And I didn't have an entry area. And there should be a point in your life where you say, with 66% of everything that I need to feel great about this trade gone, maybe I don't just jump in, right? Maybe I don't just hope that it goes up because the fib is blue. And this is where you can say to yourself, and Pete, this may help. Because the momentum isn't great, because I don't have the areas inside of triggers, let me force the market to give me one of those reversal bars in the direction of the trade. Let me force confirmation because it establishes risk. And yeah, you took a super quick exit because the awareness hit a second late. But guys, this is one of those times where if you're hell-bent on taking the trade, force it to go in the direction of your trade. You've already given up so much. You might as well let the market help you a little bit. And then he gets his head back and he goes, wait a minute. Let me go short because this thing's not going up. And you did. And you went short directly into the fib. Your exit was the more conservative entry, getting to the other side of trouble. You went into the fib, right? Right at the fib. You could call it at the fib. I'm going to call it directly into the fib. Every trigger's above it, directly into the termination condition. That's okay. This is your trading. Look at the momentum, right? And it already failed where it was most likely to go up. Your chart reading said, no, that was wrong. I need to go the other way. I'm surprised you didn't just hit reverse. And then as you come down, your entry or your exit here, Pete, is the perfect momentum look. You could have held. You didn't have to. You already made money. And then you let it get below the next trouble. And you get in and you get out with a loss of momentum. And then everything is still going down and you get back in and you get out of the fib. And this is beautiful trading, guys. And I think that what I wanted to really illustrate with this is that you're not going to do everything right 100% of the time. You're not going to do it right 100% of the time. I don't care how good you are. Pete's a brilliant trader. This is an avoidable loss. He got his wits about him. There's only a couple ticks. This is an avoidable loss. And the way this classroom works is I know Pete's a brilliant trader, and I know Pete doesn't need that lesson about a confirmation bar. But the rest of you might. So the more you guys post in this room, winners and losers, the better everybody gets. So Pete, thank you for that. Awesome recovery. And it's pretty rad when you make money all the way down and even double dip in some areas because you know how to read your charts. Great stuff, man. Great stuff. All right, Boaz. Let's see how we're doing. Momentum, way to go. Not a strong bottom. All the momentum, potential to break. Pull back directly to support inside of triggers. That's a pretty easy one, wouldn't you say, Boaz? That's your pattern. I love it. Great picture. And you almost got all your annotations. So you may not need this lesson, but I want to do this for everybody. And I think this is important. You talked about the momentum. Stop it. You talked about the momentum. You even talked about where it was coming from. And then you're like, I'm done typing. That's a lot. To hell with that, right? But what happens is if you go through on every chart, and this is everybody, not just Boaz, I had strong triggers. I'm committed to that look. And then I only had potential to break. Why do I want you to say this out loud before you enter the trade? Why do I really want you to speak these advantages to yourself before you pull the trigger? Oops. For one reason, guys. Because now I know I may need to manage assertively. And Boaz, you probably knew that, right? But if you're a brand new user, when you look at this setup, you got to go, oh my gosh, this is gorgeous, but this is the problem. I may need to manage assertively. The entry is beautiful. The risk is virtually nothing once it goes up. Where's your problem area? Right here. If something changes, I'll manage assertively. That's why I want you guys talking advantages every time. I'm not trying to keep you out of trades. I'm trying to make sure you understand when they're not perfect so that you can manage them, so you can use your ability to read charts to manage. Great job, Buzz. Great looking trade, man. Steve Diego, happy birthday to you. Mid-band is not a termination. The large triggers were not a full bar away, so I waited for the bar to clear the fib before entry. Awesome. Lessons paying dividends instantly, right? Hopping in with all the momentum. Hopping out $220. That's a rough minute of your life, Steve Diego. Great job. Wanted to take the Nexgen momentum, but the 13.2 price was not below the fib on the pullback to the 1-to-1s. The 5-1 had to pass until it turned into a regular chili dog. So can we address this one? Steve, are you with me in here? Are you eating cake? I hope you're eating cake. All right, so Steve, the chili dog is a trade, right? Has its own set of rules, has an entry, has a stop placement, has targets, right? 100%. If you showed me your rules for the chili dog, are they the rules for a momentum trade? They're not. No, not at all. So, and guys, this is common, and we've talked about this a lot this week. Define your trade. The momentum trade, Steve, right here, is based on the potential of that area to break. That's all it is. The chili dog is letting price get beyond the area. Nexgen's momentum trade that's taught is like the early entry for the chili dog. The chili dog isn't an Nexgen trade. The chili dog is Ron saying, I want all of the price away from the fib. The momentum trade is saying, I have so much stinking momentum, I want to get in at the fib that I'm anticipating breaking, and if I get 2 up bars, I'll get the hell out. And it's typically 3, 4, 5 ticks risk. So what happens is when you start adding more trades, you may combine rules from different trades. And it changes the whole scenario. Does that make sense? So if I'm looking for a high probability trend trade and I enter like it's a high probability trend trade and I manage like it's a high probability trend trade, but it turns out it's a 50-50 trade, well then not only did I potentially break the rules for entry, but I may not manage it as assertively as I need to. So guys, be aware of that as you add trades. Make sure that you can keep them separate from one another. And that's why I think being able to define the trade that you're entering gets you focused on the rules that it takes to be the most successful with that trade. And yeah, Ron, first time Ron posted the chili dog, because there's no pullback to an area inside of favorable triggers. I'm like, what do you call that trade? Because I wanted to know how he was going to manage it. And he goes, it's mine. And it took me a minute to come to terms with that. But it's his trade. And it's not my job to tell you guys how to trade. It's my job to help you understand advantages. And Steve, either way, it's beautiful, right? So you could have taken it as a momentum. You chose to take it as a chili dog. but two very separate entities. Either way, it's gorgeous trading. Momentum and path. Momentum and path all the time. Momentum and path over and over. Momentum and path. Learn momentum and path. You'll be amazed at what you can come up with. Josh, always annotating. Awesome. Odds favorable momentum? Yep. Clear path? Absolutely. We're taking this one right up here with momentum and path. Perfect entry at the mid-band inside of triggers. First target 8 ticks, second target 16 ticks. Jumped out due to fear of my ass. What's FOMO? Is that FOMO's little brother? Took a lap for jumping out. Yeah. Right when everything started going right. Things dried up, right, Josh? That's part of management. Yep. So we took a trade yesterday live in the market, guys. Go look at the last 10 minutes of yesterday's video if you want. And we took a trade that I followed the KISS plan rules to the letter. And we removed all the emotion. And it was pretty funny. Because when we took this trade, was it crude oil? Does anyone remember? But we took this trade. It was the ES, Nana. Thank you. Let's go see if we can find it. It was right at the end of class. And I want you guys to see what we did. And this was it right here, right? 50-50 trade from a good top. So I'm going to come back and I'm going to scroll back and find that circle. And there it is. And what we did is we followed the exit plan on the KISS plan to 100% to the letter. So we took the entry where we were supposed to take the entry and we made our first profit target 100% and we went to break even. And inside, while we were break even, the small chart went up and down and up and down and up and down. And we bounced in between being up $12 and being up $150 over and over and over. And it took, how long did it take? It was like, oh my gosh, we got in at 37. We got stopped out at 52. It was 15 minutes of emotional angst watching fluctuations on the small chart. And Nanda, I think you said I would have exited this one 100 times, right? I would have been out of this one because it took too long, because it wasn't right. And the whole thing that I was trying, the whole point that I was trying to make is, guys, as you learn how to manage your trades, you've got to let your management plan play out. The same way you follow rules for entry. You've got to be just as committed to your exit plan. And if Josh made more money, right? But he inserted his opinion, his fears, his anxiety into his management plan. What does that mean? Josh, it means that you don't trust your management plan yet. Which means you've got to figure out a way to develop trust. Can I give you a way to do that? One of the most underutilized tools is market replay. So Josh, your job this afternoon, this weekend, is to go back and replay today. And take this same amazing trade with every one of those advantages. And the only difference, Josh, is instead of jumping out because of fear, let it hit your second target. Watch it hit your second target. Take that picture and talk about why it was important for you to let it go to that next target. Talk about every advantage you see. Talk about everything that stayed in favor of that trade. Guys, market replay gives you the ability to go back and retrade the day. If you take the wrong entry, market replay, skip that entry. If you take an early exit, market replay, avoid that exit. Steve Diego, go back and catch that momentum trade, right? And remind yourself that this is a momentum trade And then hell, add on when it becomes a chili dog. So guys, market replay is where you're going to develop trust. There's no risk of loss, none whatsoever. All you're doing is you're learning to trust your plan. It's a great trade, Josh. It really is. And I love that you wrote you took a lap for jumping out. That cracks me up. Good stuff. All right, who's next? Miss Jen again. That kind of rhymes. Jen again. Let's see what you've been doing. Pivot stop out. For those of you that aren't in the know, a pivot stop out means that the market lost momentum and then they retested it. Went above it and down. Stopped everybody out. Hey, Robbie. Welcome to the room. Test pick coming in bright and clear. Gorgeous. Excited to have you here. I'm Mark. They give me the microphone for some reason. Let me know if I can be helpful. All right, back to you, Jen. Odds favorable momentum. All right, guys, help Jen out here. And Jen knows that I know she doesn't need the help. Did Jen have a clear path? Did Jen have a termination condition? Or did Jen have the potential to break on this particular trade? We're looking right here. What do you guys think? Anybody? No clear path. It's potential. So what does that mean? Doesn't that mean that Jen knows automatically she may have to manage it aggressively? That's it. That's all it means. Doesn't mean that it's not a trade. Jen, smalls were a full bar away, and that was the better entry. I agree 100%. But you get in on the other side of small triggers, and you're able to capitalize. And this is where the speed of the NASDAQ will affect you. The entry was up here. The final entry came in down here. As you learn a new market, as you learn its speed, as you learn its characteristics, it will take you a little bit to learn how to trade it. Jen knows the rule. She went back and annotated the rule. She knew where the best entry was. She didn't get it. She still made money because it's the right trade. But now she's one step closer to being more efficient with less risk because she took the time to annotate, to go back when the trade was over, to identify anything that could have been done better, and to write herself a mental note or a physical note. That's where my entry should have been. But with all these advantages, it was still pretty easy to make some money. Great trade, Jen. And great self-awareness. It's not easy to do. Because sometimes with self-awareness, you have to admit that maybe you didn't do it right, or maybe that you could have done it better. And that's just part of it. The small's on the small chartered key. I agree 100%, Jen. I think if you're going to trend trade the NASDAQ, that's the difference between getting run over a lot and getting paid a lot. All right, not a trend trade. I never saw trades like this until I learned the high probability trend trade. I believe you. Black arrows don't mean nothing, just wanted to look like Zorro. This is why I love this class. All right, with one-to-ones, divergence, price tends to go past the area inside of triggers. So this is a pattern. There's a loss of momentum. The path is clear. Divergence from a one-to-one. Entry after the divergence prints. And understanding that it typically pushes past the perfect trend trade and targets right before the reversal bar marker. Guys, this is the pirate trade. This is very much like what Wayne does. Recognizing patterns, understanding that there's times where it might be appropriate to fight the trend, that there could be a pattern that wins more than it loses. And Ron does it like an expert. All right, this is one of my favorites. Joel, you're a good sport, so I'm going to give it to you here. From a strong top or bottom, you said yes. Odds favorable momentum, you said yes. Smalls outside of the large, you said yes. No divergence, you said yes. Enter at the area. So Joel, this is that same lesson that we talked about with Jen. I'm going to ignore the fact that you traded into a termination condition because you had enough advantages. You felt like this was the right trade. So on the NASDAQ, Joel, I hope this is helpful for you. When you reach your area inside of favorable large triggers, okay, so when the large chart says go and you reach the area for entry, if your small triggers are a full bar away above the reversal bar marker, I'm going to annotate this one and put it into my spreadsheet. If the small triggers are above the reversal bar marker, not market, marker, enter at the area and be prepared to manage if the triggers act as resistance. So this is one of the best lessons I can give you guys on the NASDAQ. And I'm going to go put it into my spreadsheet because I think that this will pay dividends for a lot of you guys as you move over to the NASDAQ. Because what it does is by focusing on those small triggers being a full bar away, remember, this is a different time frame, and it almost works very much like the gap theory. If you get in at the area inside of triggers, you've got 6 ticks of risk, right? If you enter on the other side of the triggers, you've got 46 ticks of risk. So the triggers tell you. But if the triggers are coming down strong against you, that's when you pump the brakes. That's when you wait. That's when you say, oh my gosh, those triggers aren't a full bar away. Let me wait for the close on the other side. Jen did the same thing you did right here. Same lesson, but with the speed of the NASDAQ, sometimes it's hard to do that in the moment. I know that it is. Great trade though, Joel. Awesome trade. All right, Gary. I know you've been waiting, brother. Let's do this. Let's take a look. So large chart. Let's talk about it. Large chart says odds favorable momentum. Can we annotate it together, Gary? Because I firmly believe annotation is what's going to get you to where you want to be. So this is where the trade originates. Are you with me in here? So I go through the process every time. Did I have strong triggers? The answer is yes. Did I have a clear path? The answer is yes. And even more so, I'm going to take your big circle and I'm going to make it a small circle. Did I have an area inside of triggers? And once again, it's a yes. So Gary, this box right here was your entry for the highest probability trend trade you could take. You had momentum, you had path, you had an area inside of favorable large triggers, and then it even gave you a reversal bar so you knew where your stop would go. Does that make sense? Are you with me in here? I hope you're with me in here because you're nailing this. A weekend, you know what you're looking for. Does anybody remember what the one thing that will take me out of a high probability trend trade when the large chart's perfect? Three divergences, and the third was higher even. So this is an exit condition, and you might have given up a couple ticks on this one. And look what the third divergence did. It pushed it up a little bit. Would have taken out your stop here as well, but you could have been out a little sooner because of divergence. And it doesn't look like it gave an opportunity for the re-entry. And this is one of those times where you take the perfect trade. Maybe you give up a couple ticks, right? And you just have to wait for the next one. And that's a part of trading. But by having an exit plan, if you took this one per the KISS plan, you would have been stopped out right there when it took out that previous pivot. But you might have 55. Let me extend 45. You actually might have made $100 and broken even with the KISS plan. So this still might have been a $100 trade. But what I really want to talk about, because I know that you're new, is that you understand what you're looking for. You understand that the advantages on the large chart force you to look for the entry. And then with a little bit of study, some practice, and we'll give you some feedback, you'll learn to refine this a little bit. And it'll create some opportunities for you. Great job. I hope you were listening. And guys, if you ever need to leave, I don't want you to miss out on feedback. Tell me you have to leave. All right, Chef. Not the best top, but I had odds favorable momentum. I love that because I can hear the voice. It's not the best, but I had this, right? They pooped in my brownies a little bit, but it's not a lot of poop. I can still eat them. That's all right. That's determination. Good stuff. Everything heads down. You get the pullback. I'm trying to figure out. You got excited. Got in at the bottom of the bar. Oh. And then you get stopped out. And it looks like you get back in. And you take it down to the mid-band. And then directly into the mid-band. You take it again down to your fib. Close for your daily goal. I love it. So, all right, Chef. Are you with me in here? Did he leave? Nope, there he is. Okay. So we talked about this with Pete earlier as well, Chef, and I think that you're going to like this. I really do. And that may have been what got you. Let me read your mental mind real quick. After just over a year with Mark, I realize I still need this class. Aw. Helps me manage my trades and work on my patience. Despite the error on the first trade, I was still able to recognize the opportunity was still there. Amen. Thank you for that. So, Chef, the one thing I love to tell people, if it's not perfect, right? If the entry's not perfect, and the reason I say that is because it could have retraced to here, but it also could have closed the gap to those triggers all the way up at the fib, right? We know that. That's very basic 101 is price returns to large triggers. So you have this huge zone where it could have snapped back to. That down bar, that reversal bar, that confirmation that it is in fact going down becomes an awesome entry. And it's an even better entry than the one that you panic jumped into. And it eliminates the loser. And it establishes your risk. And that one just lines you up straight to the mid-band. And then it brings you right back to that perfect little momentum style to take the second leg. Does that make sense? If it's hard to pinpoint where it's most likely to continue, force it to continue. And it's almost like that's what you were doing here. And it just faked you out a little bit. It started to go down and you said, oh shit, it's going down. Done it. You called it a mistake. I agree. But we all make mistakes. Great recovery. And I agree 100%. Great recovery. Just because you made a mistake doesn't mean that it's over. And you knew that and you capitalized. Back when I was a younger, much better looking man, I used to race motorcycles. And there were two classes. There was the novice class. That's what all my new users are here. And there was the expert class. And that's where Chef sat. And the only difference between the two, the equipment is the same. You guys have the same software. The only difference is the experience. And the experience to react from mistakes. Does anyone in this room, and I'm raising my hand again, did anyone in this room when they were new, or maybe right now, you make a mistake and you spend the next 10 minutes pining over it and being pissed off and wondering what went wrong and then you missed the perfect trade? Done it. Hundreds of times. Not proud of how many times I've done it. That's the difference. Because once you trust the read, you'll say, whoops, screwed up. That's the right trade. Let's go. Pete, if your ears are on, Pete may already be gone. Pete's one of the best that I've seen of that. He'll make a mistake and he'll recover instantly and capitalize, and it's like he never lost a dollar. Guys, sometimes you take chances, sometimes you make mistakes. But when you trust your plan, you'll turn it around and get the right trade. Great job, Chef. Great recovery, dude. Tried a sim chili dog, turned into a trend trade with odds favorable, momentum, and clear path. Absolutely. Everything is up. Back of the bar clears. Wayne, you take the chili dog. When the chili dog doesn't work, you let it turn into a trend trade and get paid. That is about the best use of the chili dog that I've ever seen. Because once we close on the wrong side of those triggers, it's more likely to retrace. And great job, dude. It took me a while to understand the chili dog. I made a lot of mistakes learning that trade because while it seems very simple, there's more to it. And then great recovery. And then Chef, just to compound on what I was saying a second ago, his entry isn't perfect, so he forces the market to confirm. And then with this look, it's pretty easy. Great job. Awesome work, Wayne. Back in, confirmation bar, and you got slipped a little bit. You almost always do on the confirmation bar. Great job, dude. Man, you guys are crushing it with pictures today. This is going to be the best YouTube video ever. All right, Steve Diego, odds favorable, back of the bar clears trouble. There's my chili dog rules. You're in at 24 though, which means that you probably didn't wait for it to clear trouble. Oh, stupid Mark. So you entered at 28. He hasn't given me a raise in years. But at 28, I'm trying to figure it out. Back of the bar clears here. You get in on the next bar. Turns into the trend trade. And there's Wayne's rule, right? If the momentum trade doesn't work, it turns into a trend trade. So Steve, I'm not sure if you're still in here, but it would appear at the time of your entry, you were anticipating the bar to break. Maybe it didn't yet. Because I don't think it actually broke until up here. Because there's your pullback. Maybe it did. I don't know. It's hard to read. That bar was at 30. The top of that bar was at 30. The top of the bar you entered on was 30, which means that's where the top of the bar was. It absolutely cleared? Okay. I like it. And then you lost momentum. It turned into a trend trade. And you exited at the area inside of triggers. So that's the old putting the exit right where the next entry is. And then you could have re-entered to take the trend trade. So great job, dude. Great job. Just didn't work. Sometimes they don't. Sometimes they don't. It's frustrating to people, but that's just a part of trading. All right, Wayne. Coming from the HVA with market flow small triggers up. So Wayne, they're actually down against you. Your fast triggers are down against you. 100%. Not from a termination. Does that make sense? The fast triggers are down, and I think that's what gets you. And it's just, there's no reason to go long there. It's from an HVA line, I agree. Yeah, it happens, right? And then same thing. You're like, uh-oh, that's not the right trade. Let me go the other direction. Let me go with everything, and then that was pretty easy. Pow. I like the HVA. So one of the things, Wayne, let me show you. Let me see if I have an HVA chart somewhere. So one of the things with the HVA lines, and I love them, man, and they create all sorts of warm fuzzies for me, is if you're using them not from the termination condition. Let me see if I can find a good example. That one's from a termination. It's golden. But sometimes they print in the middle. And that's kind of what you had. Make sure that you have odds favorable momentum if you're just going to buy an HVA line. So like this one, the faster up, but the other ones are down. And if you look at the large chart, there's no terminations. So arbitrarily buying an HVA in a situation like this, probably not your best bet. That was your trade from the edge up. And now you have to go back to that large chart. This HVA isn't in the equation because you don't have odds favorable momentum because you're not coming from a termination. It's less likely to work. Does that make sense? That was one of the things John Novak and I have been working real hard on is when to take advantage of those HVAs and let momentum, if they're not the HVA trade rules met, let momentum lead the way. I love it, but great recovery. Turned right around, came off the termination, went short, made money to the outer band, and then there's your outer band trade. Boom. Let me anticipate the pullback because of the outer band, and just freaking nailed it, dude. Great recovery. We're seeing that with experienced users. Take a chance, make a mistake, whatever it is. But when it's wrong, it's wrong. Jump right back into right mode. Great job on that, Wayne. Wayne used to race motorcycles. He knows the difference between a novice and an expert is recovery time. All right, Miss Cindy. Same trade as your husband, right? No, maybe not. Strong triggers, clear path. You get in at the pink 1-to-1s. Last corner and the lap no longer matter. Yep. That's it. So Cindy, one thing when I teach entries, fibs, midbands, yellow 1-to-1s, these pink 1-to-1s on the NASDAQ, I guess they can come into play. I'm not sure where your trigger lines were when you got there. It looks like they might have been less than a bar away. And notice that the market didn't continue up until they got to the other side. And then once they did, it did everything you anticipated it doing. Does that make sense, Miss Cindy? Getting in on the wrong side of the triggers creates challenges when they're against you fast. But once you get in on the right side, off it goes. And then you see it again up here. Once it gets above the triggers, it's pretty easy. I hope you got that lesson. It seems to be a reoccurring lesson for a lot of people. And then here's the beautiful, the other side of it. Odds favorable, 50-50. And then you jump in way early. And it goes right to where it was supposed to. And look at where the triggers were. Full bar away. That's when you get in at the area. You get profits. And then you're out a tick or two below break even. And for me, this is right at the area inside of triggers. I'm almost tempted to say with the divergence, or you have to put your stop where the market won't go, but you were protecting your profits. So nice job. Great job, Cindy. That trigger lesson, guys, I'm telling you, NASDAQ traders, gonna pay dividends for you. Momentum. Break it, area inside, just momentum trade and ride it down, huh, Joel? When everything is screaming down, it's hard to stop. And you get in on the other side of the fib. I don't know what kind of trade it is. It's a JTFI trade. It's a jump the fudge in trade. But with momentum on 3 charts, it's going to be hard to stop that market. And you notice that the market, guys, this is a great lesson, NASDAQ traders. Notice that the market didn't retrace until it got to the other side of the small triggers. The same reason, fighting those small triggers, trying to go long against them doesn't work. Joel, do you see how this could be a management opportunity for you to hold these trades longer? Force it to give you the reversal bar. If the only thing you're banking on is momentum, force the momentum to go away. Lose that advantage before you cut ties. Not to be the crash dummy. Steve, I was the crash dummy. I blew out 15 accounts in 3 days learning that lesson. And you know what? Let me show you guys how the lesson came to be. Because at first, I thought I just sucked. I thought, man, NASDAQ's stupid and I'm stupid and woe is me. And then I did this with it. I said, all right, I've got pictures of all these trades. And I just started clicking through them. And I was like, what's the one common denominator? And I'll show you the picture that fixed it for me. Let me pull up my spreadsheet. The picture that fixed it for me. Let me see if I can find an example of it. And guys, this is why patterns are so important. Man. Wait for the close. Close on correct side. All right, this is it right here. Steve, this is what I noticed. Is that these trigger lines, when you get to the area and they're super close, behave as resistance. And it took about 3 days and 40 trades for me to see this pattern, to recognize this pattern, and then to go back and back test that pattern. And it was as simple as getting in on the right side. You can do trailing stops, Gary. Absolutely you can. You could chase it all the way up. So, for example, on Joel's, where I said, as long as it's trading on the other side of these triggers, let's see if S&P is given a better example. It's already on the wrong side. So, as long as, I'll show you one of the ways that I trail, Gary, just to give you a little fodder to work with. And I'm going to pull up another picture that kind of illustrates what we were talking about with Gary's, or I'm sorry, with Joel's, my bad. So as long as price stays left of these small triggers, it's going up. And I say that with 100% absolution. As long as it's left of these green triggers, it's going up. Once it closes on the other side of them, Gary, I don't know if it's going to keep going up. I don't know if it's going to retrace and turn into a trend trade. I don't know if the bottom's going to fall out. But this is one of those things. When you're left of that momentum indicator, it's going up. And until it closes, it's not going down. Oops. So this little scenario here, it's the same thing here. You can see it stab and it doesn't go. And then here it closes, goes up a couple bars, gets back down, cruises. And you can see the little fights along the way, but it doesn't go up until it closes. So one of the things that you can do, and we'll do this, arbitrarily buy it. If it doesn't close below these triggers, it's going to continue up. So one of the ways you can trail is you could put a stop right at that reversal bar marker that we talked about earlier and just keep chasing it. And every time you get an up bar, you have less risk. And until you get a down bar, it's going up. Now the idea is that you want momentum and you don't want termination conditions, but maybe you're already $500 into a trade and you hit a line and you're like, you know what? As long as it doesn't close on the other side, it's going to go up. But once it does, you could trail a stop and literally, I've chased the NASDAQ reversal bar, reversal bar, reversal bar, And it never takes me out until that one. Same thing here. If you took a long trade, you could literally trail right behind it. So you can move stops and targets, you can trail them. Ideally though, if you're in a trend trade, one of the things that new users tend to do is they move their stops too quickly. Have a reason for your stop to be where it's at. And initially it's where the market shouldn't go, on the other side of those triggers. But if you're in a momentum style trade and you know that a loss of momentum takes away your advantage, it's a great way to take advantage of a little bit bigger moves that you might not have caught. Does that make sense? We did that once in class and it didn't stop for like $700 or $800 chasing the reversal bar marker. But of course, you want the rules met. Because trading directly into a termination condition, you're more likely to get that bounce against you than you're not, as compared to room to the target. Mike, I feel like you don't listen to me. Just kidding. But check it out. I mean, this is it, right? You get left of the small triggers, and it doesn't go back up till you get to the right side. And it happens again and again. And look at that move. So if you were in this trend trade, I don't know, Gary. They may have a way to do it. But do you really want to put your financial decisions in the platform when you have every tool you need to make good choices? That's kind of how I feel about it. I love being in control of my destiny. I love looking at my indicators and saying, there's just no reason. What if Ninja trails a stop right where the market shouldn't go, or right where the market should go? Exhibit A. What if Ninja Trader put a stop, hold on, where was Cindy's? What if Ninja Trader put a stop right in an area inside of favorable large triggers? Ninja Trader doesn't know my plan. My plan keeps me on the good side of things. I hope that makes sense. But you have Simulator. I would say practice with it. You may find something that works for you. I don't know a way to do it with the automation. So yeah, Iron Mike, scroll back and you'll see that it's just a gospel truth. Look at that. Until it closes, it's going down. But what happens, decisions are made at key areas. That's where you start to see those bounces. There it is again. You're welcome. Here, let me give you the pictures too. Here's go in either direction. You can steal those. Valentine's lunch. Ooh, I like it. Shrimp, lobster, and a nap. That sounds good. That sounds delicious. All right, guys. We're coming into the end of it here. And that's okay, Mike. I'm telling you, you're going to learn something every day. Crude oil today. Where would you have gotten in? That's the one that you circled, right? So one of the things, Gary, is you say it could have been 200 ticks. Look at that bounce off of support. Are you willing to hold into an area that could stop the market, that turns the triggers, that gives multiple divergences, right? And then once you break below it, there's the opportunity for money. And then once again, you can get out right at the key area that creates all the ugly, wait for it to correct, and down you go again. And that's one of the advantages of the software. It's easy to say, and believe me, I am a hypothetical, looking in the rearview mirror. hindsight's 2020 badass. I could say, look, if I just would have gotten in at this divergence and then gotten out down here with weak triggers, I would be rich beyond my wildest dreams. And it's easy to say that because I can see after the fact where the move started and where the move ended. But the reality is that there were so many account draining problems in between that I have to believe a little bit that maybe that whole move wasn't my move, that maybe my highest chance of success, because of how precise things are, is I'll get in on the other side of something bad and get out at something bad, and get in on the other side of bad and get out at something bad, and get in and get out and get in and get out. Ooh, avoid all that, get back in, and maybe get out with profits. And that's what we do, and that's why this software is so freaking amazing. Because it gives you the ability to take a big picture and refine it into a high probability scenario on a smaller, faster chart that reduces risk, that helps increase profit. And you know exactly where the bounces are most likely to happen. Because at a fib, there's a bounce. At a fib, there's a bounce. Divergence high, there's your bounce. There's a bounce. All of the bounces, when the areas are stacked a little bit, there's never any reason to have to sit through that, to take that big drawdown. Because everything looked amazing, like it was going to hit that next 200 ticks, and the market reversed. And I guarantee there was something on that smaller, faster chart, away from the fact that there was an odds favorable momentum, that helped kick off that reversal, that helped us recognize it. 70-20, and it was that blue fib right there. Kind of cool. Does that make sense, Gary? And you're right. There probably was 200 ticks worth of opportunity in there. It just doesn't have to all be in one big shot. That's the beauty of day trading futures. Because in futures, and I said this earlier, your account doesn't care if that $1,000 got there $50 a time, or $100 at a time, or $300 a time. The goal is to get there with the least amount of exposure. And Mike, I appreciate that you still listen to me. I talk to John Novak every morning. I'm in a learning state every morning. As good as I am reading the software, as confident as I am in what I see, there's always something to learn. And I love that. I love that we have this arena. And when you guys ask me something, I get to help too. 20 bars in 3 hours, yeah. Or you could go to the NASDAQ and it's 20 bars in 3 seconds. And some days it's volatile and some days it's not. But we don't trade. I say we don't trade. You do whatever you want. I teach patterns. That's all it is. So whether the pattern takes 3 hours or whether the pattern takes 3 minutes, it's just a pattern. And it's the pattern that's been proven to win more than it loses. Odds favorable, 50-50. I love your entry. Wayne says, it should go somewhere from in here, but I'm not sure. So let me force it to go down from that area. Nicely done. I like it, Wayne. And then second half of it. Nope, this is just a jump in. Momentum, 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 jump in. 2 ticks below the lowest price. It's nothing but momentum. He's not going to risk a lot. There we go. Back out at divergence. Second half of the trade. I did, Cindy. He fought the small triggers on the entry. If he would have waited for the close on the other side. It's that same lesson that I talk about every day on NASDAQ. If you fight the small triggers, you're more likely to get run over. And Gary, you're welcome, man. I sure hope we get to see a lot more of you. I hope you decide to come on and use the software and learn the software and give me the opportunity to help you grow with it, because I really believe that we can accomplish anything with just a little bit of feedback in this room. So good stuff. You're welcome, Cindy. Jeffrey, do you want to go through how to set up market replay? Guys, do you want to do that this morning before we call it a day? Yeah, let me close out all of my workspaces real quick, because when I start on market replay, I literally just open NinjaTrader, and once you open NinjaTrader, let me close this out. There we go. You tried it again on the weekend. It's being a bugger. Cool. Language. Gee whiz. All right, so I open NinjaTrader. Most of you guys have it connect, right? Connect on startup. You have to disconnect from your live account. Hey, you were, Jen. We're at the end of class and it's Friday. And it's Valentine's Day. I'm going to be a little silly. So I'm going to disconnect from my live account. Oh, and you know what? Before we get too far into this, I'm going to give you guys a fish, but I'm also going to teach you to fish. So I'm going to go to the trading guide section, and I'm going to give you the link just in case you need it. But this will also be on the YouTube video, guys. So I'm disconnected. There's no live data, and the only thing up is my control panel. I'm going to go to connections, and I'm going to go to playback. Disregard all these different connections I have. And once I click playback, it's going to say, hey, Mark, long time no see. What market do you want to replay? And I'm going to say, let's do crude oil. And they're going to say, that's awesome. What day do you want to replay? And I said, you know what? I made some mistakes on management yesterday. I got out too soon. So I'm going to go to the 13th. And I'd like to replay the 13th like it was a live market. And I'm going to hit download. And it's going to take just a second because I have a crazy fast computer. And once it's done downloading, it goes back to looking normal. Hit continue. And up comes your little playback thing. So here's a pretty key thing. Dun, dun, dun. Oops, that's my actual one. So Jen, this could be part of the challenge. Make sure these dates match. So you don't force Ninja to try and load a week or two worth of data. It'll choke. That's what you get. Hold on. Please close all the other connections. So Jeffrey Dean does not follow directions. So remember when I said the first thing you have to do is make sure that you're not connected to your live data? You didn't. As long as there's a green, so let's do it again. Let me disconnect. And guys, we got nothing but time. So if you're going to do this, Jeffrey, and you see the green button or the green dot, whoops. And I don't know if we could see it in your picture or not. Yep, see? You're connected. So what you need to do is come to connections and disconnect it. And then go to connections and then do playback. And you have to do them in that order. Then you pick your market, then you pick your day, then you download. So give that a go. Let's do it together. Didn't click hard enough? Need you to work that trigger finger, man. Yeah, it's very possible. I click with reckless abandon. So guys, make sure on your little playback thing that both are on the 13th. So we're going to start on the 13th. We're going to end on the 13th. Once this is ready, go to workspaces and open up your crude oil workspace and let it load. And it's going to come through, and what it's going to do is it's going to start you at midnight, the morning of the 13th. Make sure that your ATM strategy is in place. Maybe you're doing the KISS plan. And then here's the great stuff. It is so fast, Wayne. It is ported and polished. So here's the cool thing. I can hit play. It's midnight, guys. There's nothing going on. I can speed things up all the way up to there's 100, there's 500, there's 1,000. It's untradeable. But I can speed it up if I want to. But here's the deal, guys. Pause. There's a pause button. So when you think your rules are met, go to your checklist. Are they actually met? The one thing that people do, guys, we all have giant freaking egos. The one thing people do is they trade the market and they're like, oh, I remember there was this huge drop down right here. And they'll just jump in and they'll go, I remember it bounced at 70, 60. And they'll jump out and they're like, I just made $5,000. I'm so freaking cool. Simulator women love me in my simulator mansion with simulator Ferrari. Guys, don't do that. Hit pause. Make sure your rules are met. And what you're going to do is you're going to see the potential that's there when you follow your plan. You're going to see the potential of following rules and what's capable when you actually do it. So go through, trade it. Trade it during the hours that you normally trade. Go through and fix what you break. Go through and manage the way you should have managed, right? And this is 1,000 times. There's your gap theory. Hasn't happened. There we go. Pulling back. And then pause. Wait a minute. Potential to break. Pullback support. Oh, it's not perfect. 2 divergences on a 50-50. Nope, that's not my trade. Doesn't fit my plan. Let me go to the next look. And that's how you use market replay, guys. Take pictures. And here's the best part. Ladies and gentlemen, you are cordially invited to bring your market replay pictures to my classroom. It doesn't have to be the live market. Look at that. It blew right through the mid-band, didn't it? Thanks, rules. You don't have to just bring me live trades. Bring me your market replay. If you're working on something, bring it in, annotate it. If you're doing market replay and you just want to show me how freaking cool you can be, but you don't need feedback, maybe don't clog the room with those. But if you're working on stuff, you need some feedback, bring it in. If you watch a video, don't understand something, take a picture, bring it in. Let's see what Wayne's doing. Odds favorable, 50-50. So that's the momentum trade. Little snap back right to it. And then you exited right at the area inside of triggers, right, Wayne? You're welcome, Jeffrey. So, guys, don't put your stops where the market's most likely to continue. One of the best management lessons. And is this a good loss or just a 50-50 issue? So, Wayne, what changed? Can we go through this? What changed in the trade? You still had momentum. It was still a 50-50. The difference is, because you entered up here, not at the area inside of triggers, you weren't willing to keep the risk on the trade. Everything was still up. It was still an area inside of triggers, right? So the initial KISS plan, there were 2 ticks below. But you've got to, as you grow with the software, Wayne, you got to say, this isn't my entry. This is my entry. My stop goes down here until I have a reason. And then once you get that reason, as you grow with the software, you'll start asking yourself, do I really want to exit at an area inside of triggers with this look on my large chart? Does that make sense? Yeah, and that was super fast. I see how fast it was. So you could have just re-entered even if you wanted to. I think it was I don't think it was a 50-50 issue. I think that they just danced twice right at the area because decisions are made at key areas, and that's exactly what you're witnessing here. Is the fight between buyers and sellers, but the buyers won right from support inside of favorable large triggers. Good stuff though. And this will happen every now and then. Great entries make it easier to keep the stop where it belongs. Good stuff. And then guys, when you're done with market replay, just close your workspace, save it, and then just close down NinjaTrader. You're done. That's it. Congratulations. You did wonderful.